Choosing the wrong mortgage is not going to cost you hundreds of dollars. It'll cost you $15,000, $20,000, maybe even $30,000. And I'm not just talking about the rate. I'm talking about penalties, missed opportunities, all of it. And the reason those mistakes happen are because people are only focused on one part of the decision. And to prove it to you, let me show you this example. Let's say that your mortgage is up for renewal and you're going to be selling your house in a month. You have two options. The first one is that you take a 3% interest rate and your penalty will be $10,000. The other option is for you to take an 8% interest rate, but this is an open term, which means that there's no penalty. So the decision becomes, would you rather pay $300 of interest and a $10,000 penalty, or pay $800 but have no penalty to bring? So which one do you choose? Exactly. Homeowners focus on one layer of the problem, the rate, but mortgages actually sit inside something that I call the mortgage decision pyramid. And there are 5 layers that determine if your mortgage is suitable for your life. Most people, they only look at the top, but today we're going to go through all 5. Right now you're on one of 2 paths. Path 1 is leaving your mortgage to chance. It's trusting that your bank or your broker will offer you something that's reasonable and hoping that it works out. Path 2 is understanding how mortgages actually work to make sure that you can advocate for what your family needs. If you're on path 1, this video is going to show you how to avoid making mistakes that can cost you thousands of dollars. And if you're already on path 2, by the end of this video, you're going to know more than most homeowners do in a lifetime. But before we talk about rate, penalties, and all of these other things, we need to answer one uncomfortable question. How predictable is your life in the next 5 years? Because that determines how long you should commit. And that is where the expensive mistakes start. Most people treat their mortgage like something that happens to them. The bank presents offers, their broker gives them rates, and then they decide. But when the cost of getting this wrong is so high, wouldn't you want to know that you're making the right decision? This is what you're going to be able to do at the end of this video. And like most people will tell themselves, mortgages are complicated. These guys are the experts. I'll trust them. And trusting them is not bad. But here's the thing, if a mistake is made, is it your bank or broker who's paying for it? No, you are. And their advice is only as good as their understanding of your life, which means the most important input into this process is yours. And I get asked this question all the time. What's your lowest rate? And my answer is always the same. The lowest rate for who? I know nothing about you. I don't know your life plans. I don't know what might change in the next 5 years. So giving someone the best 5-year fixed rate without understanding the answers to these questions, it feels irresponsible. The question that people need to start with is this: how well does the mortgage term line up with my life plans? How long can I realistically support a commitment? And these questions are completely different. And to push back, some of you might be saying, look, a 5-year time commitment, it's not that long. And I've seen this assumption play out more times than you can think. I've also seen it dozens of times of people coming back to me after they've broken their mortgage, wondering why I put them in the wrong term. And that's why this question is the fundamental layer to the mortgage decision pyramid. We need to understand this before we can figure anything else out. So going back to the question, how long can my life support this commitment? Let me show you 3 scenarios that I see all the time. As you listen, think about which of these 3 scenarios sound most like you today. A few years ago, I worked with a couple who were in their 60s. They had already raised their kids. Both children were out of university and living on their own. Their careers were essentially finished. One was already retired, and the other was planning on retiring fairly soon. They weren't launching businesses. They weren't relocating. Their family wasn't expanding. Life wasn't accelerating anymore. It was settling. And that changes how you think about your mortgage. Because when we talked about the next 5 years, nothing was expected to change. Their pension and their current income were going to be about the same. Their location, they weren't moving. And their household, it wasn't expanding anymore. They were going to retire with a mortgage. They weren't living in excess, but their life was extremely predictable. The next chapter of their life was already written. In situations like this, long commitments actually make sense because the biggest risk in a mortgage is not the interest rate. It's a misalignment between your life and your commitment. In this scenario, if something major changed, they would be genuinely surprised. Now, you may or may not relate to story number 1. Let's go into story number 2. This is a couple that I worked with a few years ago. They were buying a new home. They had gotten engaged. Both of them had awesome jobs. Both had great credit and no debt. Everything looked really straightforward. What they were looking for wasn't a starter condo. It was something that they wanted to be in long term. And when they were looking for their mortgage, they said something that was super reasonable at the time. They said, we're pretty settled people. We're not ones to move around. And so look, so far in the story, doesn't this one and the previous story seem to be pretty similar? They should take the 5-year fixed, right? On the surface, that looked true. But as we talked about their plans, small details started to shine through. One of them was on a promotion track at work. The other talked about possibly starting a business. And they both planned to have children. And like they didn't have any plans to make changes right now. And they weren't expecting a dramatic shift in their life. When you start stacking these possibilities and probabilities together, one thing remained clear. The next 5 years weren't as predictable as they first thought. So now let's zoom forward 2 years down the road. So one of them got offered a relocation back to their hometown. The other decided that they would take this opportunity to start their small business. And their first child was on the way. In this example, it's not like they lost their job or weren't able to afford their home. Life just moved. And when they needed to break the mortgage to make those changes work, the penalty didn't just erase the savings from taking a higher interest rate. It ended up costing them $10,000 more. That was 5 figures just to regain flexibility. And here's the part that matters. They weren't reckless. They simply misread their season. They were quietly moving. And when life has that kind of movement under the surface, long commitments start becoming fragile, which brings us to our third scenario. Because sometimes this movement's not quiet. Sometimes the movement's obvious. And here's the honest truth. If you're in your 30s and 40s, most professionals aren't living in a stable environment. Their life still has momentum, and that momentum matters. So now let's look at our third couple. This was a dual income couple. They were in their late 30s. Both had a strong corporate career, good credit, all the important things. Once again, on paper, everything looked stable, but they already knew something important. In 2 years, there was an opportunity for relocation. So their thinking was simple. Let's take a 3-year interest rate because the rate savings would cover the penalty in comparison to taking a 1 or 2-year rate. On top of that, this was right after the variable rate had skyrocketed. They just wanted to avoid variable rate at all costs. So their decision felt obvious. Take the 3-year fixed rate, break it, and pay the penalty when you need to. But as we talk more, something else surfaced. They said they're looking for the right house in the right neighborhood. And if something appeared in the new town before they relocated, they just buy it and hold both. They could afford to carry both homes for a while, but this created another problem. Because if this opportunity happened, they would need the equity in their home in order to use it for a down payment on the new home. And this meant that they might need access to equity before they moved. And so suddenly the question changed. It no longer was, what's the lowest rate? It became, how much flexibility can I get if this opportunity arises? And this obviously is not a quiet season. It's a dynamic one. So instead of forcing their life to fit into their mortgage commitment, we instead built flexibility around it. We ended up adding a home equity line of credit. And this was added to the property so that they had access to cash when they needed it. So now the mortgage didn't control their timing. They did. So if you step back and you look at these 3 stories, you'll notice a pattern. Some lives look predictable, but are quietly moving underneath. And some lives are actively changing. Those are 3 different financial seasons: stability, transition, and growth. Stability means that your life is predictable. Transition means that something could change. And growth means that life is already changing. The first story had a couple who were in their stability season. They had a low probability of relocation, a low probability of career shift. And the same goes for their income, their family, and they weren't in a position to change strategic positionings. Life is predictable for them. And just remember, you notice how I don't say comfortable, I say predictable. If something changed, it would genuinely surprise them. That is stability. The couple in the second story were in transition. Even though they said, we're fine, nothing's going to change, and we're probably staying. Probability is not stability. In this story, their life was comfortable, but it wasn't predictable. I would say that these people were transitional because they had career acceleration. Remember, we were talking about a possible change in job and a business being launched. And nothing was decided, but there was multiple possibilities. So you got to think these possibilities and probabilities, they start stacking on top of each other. And possibility, they compress predictability. This is the season that most upward moving professionals find themselves in. And this is where most overcommitment happens because life doesn't feel unstable. It's just not fixed. And just remember this, a transitional season means nothing is actively changing, but a lot of things could. The third story was a couple who were in their growth season. Growth is active movement. You already know something is changing. You're launching something, you're planning something, you're relocating. This can be building, restructuring, buying. In growth season, long commitments rarely align, not because growth is reckless, but because growth is dynamic. So dynamic seasons require optionality. And just remember, the mistake that people make is not choosing the wrong rate. And I hope by now that you can understand why. It's choosing a mortgage commitment that doesn't align with their life. Because most mortgages don't break because something goes wrong. They break when life moves faster than the commitment that you sign. So if you've already downloaded the workbook, go to section 1.1. I want you to write 2 lists. The first one is, what is unlikely to change in the next 5 years? Be honest. This is not what you hope. This is what is structurally unlikely to change. Second, I want you to make a list of what could reasonably change. So, and if you're struggling to think of things, think of a couple of these examples: relocation, promotion, career change, business idea, children, possible renovations, building a new home, moving, looking to downsize, upgrading your neighborhood. All of these things are possibilities that could create change. Just remember, even if it's not 100% sure, write them in each of these sections. If the second list is long, you're definitely not in a stability season. You're either in transitional, or if you know something is going to happen, you're in growth. And no matter which of these 3 seasons you lie in, this is not weakness. Because just remember that mortgages don't break based off of ambition. They break because of an overcommitment during a transitional or a growth season. Now we define the most important distinction in this entire section: your stability window and your commitment window. Most people assume that they're the same. They're not. Your stability window is how predictable your life actually is. Your commitment window is how long your mortgage is actually locked in for. And when your commitment window is longer than your stability window, that's where problems arise. Just think of it like 2 timelines. The first timeline is your life. The second timeline is your mortgage contract. How long has the lender locked you in for? When those 2 timelines match, things work out perfectly. But when the mortgage timeline works past the predictability of your life, that's where mortgage break risk occurs. So to hammer this home, this is not how confident you feel. It's not how strong your income is either. All we're measuring here is predictability. And so if you want to measure this, we measure this in 4 separate areas. We measure it across income, location, family, and strategic decisions. So for income, how likely is it that your income is going to stay the same? For location, how likely is it that you stay where you are? Family, how likely is it that your household is going to stay the same size? So income durability, this is how likely your income is to stay the same. Talking about a promotion, retirement, possibly changing jobs, going back to school. All of these things can change your income. And if you think that promotions are only good, think about this. If you were to be denied the next promotion, how likely are you to change jobs? This is something that's often underthought about. And most people just assume that everything works out. But for every job posting that exists, there's dozens of people who applied and didn't get the job. So just understand that that is still a risk factor, even though most people think that the worst case scenario is that they get paid the same amount that they do today. The second thing to think about is location durability. When you think about this, this is the downsizing. This is the needing a larger home. This is moving to a different location because your job or some other reason. Thinking about how durable the chances of you staying in your home, how likely you are to stay in your home, this is location durability. The third factor is family durability. And yet we've talked about this. If you're single, what are the chances of getting a spouse? If you have a spouse, what are the chances that you have kids? If you aren't thinking about any of those things, another thing that people often don't think about is their parents. How likely is it that your parents might move in with you? Any of these changes could affect the stability and which mortgage term you should choose. And the last is strategic durability. This is, are you staying on the same financial path? Are you starting a business, buying a rental, going back to school? Every one of these things, they shorten your predictability. So if you think that several of these things could change over the next 3 years, your stability window isn't 5 years. Now, if you're watching this story and you're thinking, how can I apply this to my life? I've put together a workbook with some activities for you to follow along. The link is in the description below. Now let's look at the other side, the commitment window. And this one's simple. It's how long you're locked into your mortgage for. This can be 2 years, 3 years, 5 years, but this can also matter when we talk about fixed versus variable, because a fixed rate has the chances for higher penalties than variable rates do. And leaving any mortgage contract early can create friction. We talk about penalties, requalifications. Now, when you put these two timelines together, you need to compare. Is your commitment window right now longer than your stability window? If it is, you currently have risk. So here's the sharper version. If your life changes faster than your mortgage will allow, you'll eventually pay for that misalignment. Not because you're reckless or the rate was bad, but because the timelines didn't match. And this becomes clear if we go back to the 3 stories that we've talked about before. Think about the retired couple. Their kids were finished university. Their careers were winding down. They had no relocation plans, no new ventures. Their income durability was stable. Their location durability was extremely high. Their family structure was already set. And their strategic direction, it wasn't changing. Almost every variable in their life was stable, which means their stability window was really long. In this example, a longer commitment window, it's not dangerous because the probability of life moving faster than their mortgage was low. Their stability window and their commitment window, they matched. And that is real stability. Now let's go back to the newly married couple. At the time, they felt settled. But when you look under the surface, there were signals everywhere. Promotion track, possible business, the fact that they wanted kids. Even 1 or 2 of these things would probably lead me into the transitional bucket. But all of these possibilities added up means that they were in transition. Their income wasn't fixed. Their location wasn't fixed. Their family durability was about to change. And honestly, they were too early in their relationship to really understand their strategic direction. That means that their stability window wasn't for 5 years. It was probably closer to 2 or 3. But the mortgage commitment they chose was for 5 years. And that disconnect, that's where the break risk occurred. And when life accelerated, the penalty was just the price of the mismatch. Now let's talk about the relocation couple. They already knew something important. They knew for a fact that they were going to move in 2 years. That alone shortens the stability window. Maximum 2 years. But then another variable appeared, them wanting to purchase a house before they moved. And so this is where we go from quiet movement to active movement. And this means that their stability window is really short. If we had locked themselves into a long 5-year term, then their mortgage would have determined their life. Their mortgage commitment stayed shorter so that they had flexibility and maneuverability. And when the opportunity appeared, the structure absorbed that. And that's the difference that alignment makes in all 3 of these stories. And the problem is that at signing, all of this feels responsible. The regret, it doesn't show up until much later. And it's only at that point that things start to feel unstable. And so here's the thing. If you would ask yourself a couple more questions before making that decision, then you'd be able to see how unstable your life is before you make a mortgage decision. So now you understand seasons, you understand stability windows, and you've seen through 3 examples of what happens. And the more capable you are, the more chances that life is going to shift. And upper moving households often overestimate their stability because confidence feels like predictability. And those 2 things are not the same thing. Confidence is psychological. Predictability is structural. You can still feel certain about your life and still have these 4 open variables. None of those things are part of the plans, but they're all possibilities. And I want you to start designing your decisions based off of probabilities, not assumptions, not momentum, not optimism, but probabilities. And mortgages reward alignment and they punish probability denial. Once you internalize the stability window and the commitment window, you stop fearing volatility. You start respecting misalignment. Because here's the truth. People often say the bank screwed us. The broker didn't explain the penalties and the market changed it. All of those things could be true. But you know what I don't hear? I never hear them saying we misjudged our season. And look, I understand blame feels cleaner than misalignment. But deep down, there's a moment, maybe a small one, when you realize I should have seen that coming. And that moment doesn't hurt just because of the money. It hurts because it challenges your self-image. You thought you were careful, strategic, and disciplined. You're writing a huge check for something that you actively sign. And if this is you, don't beat yourself up over it. By doing this for yourself today, you're stopping the fact that you will never have to justify this again. You won't have to defend your positions because the next time that there's a change, you'll simply move cleanly. So when you started this, You are asking, what is the best rate? You finish it by asking, how predictable is my life over the next 5 years? And does my mortgage structure agree with that? That shifts everything. And this is the basis for the bottom layer of the mortgage decision pyramid. But here's what nobody tells you. Even if you design your mortgage perfectly for your season, the lender's not going to evaluate you based off of that season. They evaluate you based on ratios, debt servicing, income history, policy buckets, qualifications. And sometimes what feels stable to you doesn't qualify as stable to them. You feel financially secure, you can still be rejected. You can design intelligently, but still be compressed by underwriting math. That's structural friction. And that's what we'll be talking about in part 2, because structural friction doesn't care about how stable you feel. It cares about how your file reads. In part 1, we talked about something that most borrowers never consider: your financial season, how predictable your life is. Because the biggest mortgage mistakes don't come from interest rates. They come from misjudging your stability. This creates the base of the mortgage decision pyramid. Now we're about to move up one more level. Because even if you design a mortgage that perfectly fits your life, you might not qualify for it. Not because you did anything wrong, but because of underwriting. And here's the uncomfortable truth. The rules, they didn't change. You just weren't shown them. Let me show you what I mean. Early in my mortgage career, I saw a file that seemed perfect. Dual income household, strong income, great credit. They were putting 20% down. Everything about this file suggested that it would be straightforward. The borrower was confident that they would get an approval, but the lender declined it. Now we took the same borrower, the same property, to a different lender. And that lender, they approved it immediately. Nothing had changed for these people. The only thing that did was the rule book. The first lender didn't like how the income was structured. The second lender, they did. And that moment, that illustrates something that borrowers almost never see. Mortgage approval, it's not just about math. It's about policy interpretation. And once you understand this, a lot of the confusing mortgage interactions, they start to make sense. Because inside every mortgage approval, there are several invisible layers that are working on your mortgage. And all of these filters are happening at the same time. And these filters are what determines what you are able to do. Most borrowers, they think the mortgage approval is simple. If I make enough money, I qualify. And income equals your house price. It's a clean idea. It's logical, but it's incomplete. Because if that were actually true, mortgage approvals would be predictable, but they're not. You've probably heard stories of one person who's got strong income gets denied, and another person with very similar income working the same job gets approved. The same type of job, same type of income, different outcomes. And when it happens, it feels random, but it's not random. It's mechanical. So let's take a look at these layers that fit underneath of your mortgage approval. The first layer, it shows why you qualify at a higher interest rate than the one that you're actually going to get. The second layer is why your approval amount might not be your comfortable mortgage amount. And the third layer explains how the treatment of your income determines what you qualify for. That is policy interpretation. And that policy interpretation quietly transforms what it is that you actually get approved for. So let's start with the first layer. This is called qualification capacity. This is the amount of debt that the lender believes that you can actually support. And that number quietly sets a boundary for what you can actually consider on purchasing a home. If you download the workbook, this is section 2.1. If you haven't, you don't need to download it. Just makes it easier for you to apply these learnings to your own situation. In this section, we're going to talk about how to figure out the maximum mortgage a lender will actually approve you for. We're also going to take a look at how much your life can actually support on these mortgage payments. Sometimes these numbers align and sometimes they don't. And seeing which one's your limiting factor is going to determine what type of property, what type of mortgage you can actually afford. So first, let's talk about your maximum approval. In Canada, lenders typically allow for you to have 39% of your income go towards your household expenses. And in total of 44%, including your housing costs plus your other debts. Those housing costs, they usually include not only the mortgage amount, but also your property taxes, $100 for heating, and condo fees if applicable. At first glance, this all seems super straightforward. Income, percentages, it just seems like math. But here is just one layer deeper that most people don't know. You don't actually qualify based off of the interest rate that you are approved for. You qualify at a rate that's higher. They call it the mortgage stress test. And here's how it goes. Let's say you're about to get a 4% interest rate. the lender's not going to qualify you as if you're getting that 4%. They're going to use a rate of 6% instead. And why is this? Because bank regulators want the banks to make sure that you're comfortable with payments in case they increase. They want to make sure that they're underwriting based off of durability, not based off of today's comfort. So while you're around shopping for a house with a 4% interest rate, the lender's quietly making sure that you can qualify for this, even if it was a 6% interest rate. And that difference, it reduces your buying power. And a lot of people don't factor this in when they start mortgage shopping. And this is just one way where expectations and qualifications, that those expectations can collide. So a lot of people ask me, how much can I actually afford? And obviously there's a bunch of different scenarios, but I like to have a general rule of thumb. It's not going to be perfect, but it'll help you understand. At a 4% interest rate, we have to use the qualification rate of 6%. Assuming a 30-year amortization, which means how long you're going to take to pay off the mortgage in full, it equates to about $600 of payments for every $100,000 that you qualify for. Like I said, it's not perfect math, but it's enough information for you to figure out how the system works. So when you run your own numbers and you find out that your housing payment number is $3,600, that equates to about a $600,000 mortgage. And look, it's super important for us to understand what the maximum that a lender will actually approve us for. But this is only part of the decision making that you should have, because most people think, well, if the lender approves me for it, I should be borrowing to that ceiling. And it's super easy once you know the mortgage number and what you're pre-approved for to start shopping at that top level of your budget. But there's a risk that appears not at the time of approval, but at a later date. That's super important to focus on, because we do need to balance approval and comfort. And that's where we get into part 2. Let me show you someone who borrows right to their ceiling and then life happens. I had a couple who was purchasing a house in the middle of the COVID craziness. People were bidding and overbidding, and they wanted to get into a specific neighborhood. They have been watching this neighborhood for years, and finally a house that was perfect for them came on the market. They qualified at the maximum, and that was the offer that they put in. They ended up winning the home. I say winning. That was something that we said on a regular basis. If you're someone who is viewing this video 10 years in the future, that might seem like an odd statement, but that is something that we said at the peak of the Canadian housing market. But here's what happened. They used every dollar of their savings in order to purchase their home. And some unexpected expenses came up. Their car broke down. At the time, interest rates went through the roof. And this pressure started building. And they ended up not being able to support their lifestyle. Look, we were approved for this mortgage. And even though interest rates have climbed, we should be able to manage. But first, all of the savings that they had done before disappeared. Now they were relying on credit cards to continue their lifestyle. But approval, it just measures your compliance to their policy. It doesn't measure lifestyle. And that's something else that you need to factor in, and that we call margin. And that's the difference between your average spending and what the bank expects you to spend. And in this case, they were coming off one of the best years for overtime, and they just weren't getting the hours that they needed. Everything felt tight. And, we ended up refinancing. We ended up getting them into a lower rate. They're managing, but that stress just weighed on them year after year after year. Now, let me give you another example, because I don't want you to think, okay, if I'm approved at the maximum, I should be going nowhere towards that. It's different for different people. So this couple ended up being in a similar income bracket as the first. They were also looking to upgrade their home, but their careers, they were just starting. They were seeing their income rise year over year over year. But because they were getting bonuses and overtime, the 2-year average for their income lagged behind what they were actually making. These people actually felt comfortable going to the maximum because what income they used to qualify and what income they actually had were actually different. This meant that they could leave some margin, that they were comfortable with these payments. And what they really wanted to figure out is they knew that their income would grow, but they wanted to make sure that their expenses didn't grow as well. So let me tell you about another couple. Similar income bracket, and they were also upgrading homes. They were both salaried employees, and they were expecting their income to slowly rise year over year over year. Now, they also were realistic. They had done a budget and realized that their expenses were also going to grow. They were looking for a second vehicle, and they wanted to go on 2 trips a year. And this was all stuff that they had budgeted on top of the expenses associated with buying a home. This couple, they qualified for more than they wanted to purchase. They chose not to stretch. They left margin. And during the same time, they ended up having to walk away from two homes that they absolutely loved because those purchases, they would stretch them to their limits. And at the time, I remember having a conversation with them. They were gutted. A year later, housing was down and it felt like the smartest decision they could have made. These two clients had the same earning power, but different pressure. And look, what you qualify for, that's what the lender determines. But margin is your choice. And this is the shift that intelligent homeowners make. Instead of asking, what can I borrow? They ask, how much pressure do I want in my life? Because mortgage approval, it determines your possibilities, but margin determines your stability. Let's move on to the third layer. And this one, we're going to get really deep. This is income treatment because two borrowers with the same income can qualify for vastly different mortgages. And like I said, not because one earns more, but because of how lenders actually interpret your income. These lenders want to see how stable your income is, how long has it existed, how it can be documented, and how the bank's policy can actually treat that type of income. Once you see how lenders interpret income, you can see how one lender can make a mortgage approval seem difficult. And another lender can have that same income feel effortless. So if you're following along with the workbook, this is section 2.2, income type identification. I want you to check what income categories actually apply to you. You can listen to them all, or you can skip ahead in the chapters for which ones apply to your situation. And an overarching note of all of these incomes. Lenders don't just evaluate income or what dollar you're making today. They're asking you how predictable that income is going to be in the future. Most people think that their mortgage is just a snapshot. What do I earn right now? But underwriting doesn't operate on snapshots. It operates on patterns. They want to know, if we lend you money for 5 years, how confident are we that your income patterns are going to continue? Now, if your income changes a lot year to year, you have bonuses, commission, business income, overtime. Most people assume that that's a problem. They assume that lenders hate variable income, but that's not actually an issue. The real issue isn't variability. It's documentation history. So most lenders, they'll use a simple 2-year average of your income. That's it. So a 2-year history. They take your income for the last 2 years, they divide it by 2. That's what determines your income. So variable income, it doesn't automatically disqualify you from approval, but it does something that is super important. It creates something called a gap. And the bigger that this gap becomes, the more important interpretation actually matters. And so this gap has a name. It's called income friction. Income friction is the difference between what income you're making today and what you can actually show to the lender. And the larger that this friction becomes, the more important interpretation actually matters for qualification instead of just approval math. So let me show you how this looks like. In year 1, your income's $150,000. In year 2, that number is $190,000. And in the third year, it becomes $220,000. If you're living in that trajectory, you're probably living as if your income is $220,000. That is your reality today. The problem, the lender doesn't actually look at it like this. They're going to average your 2 years, 150 plus 190,000 divided by 2. That gives you an income of $170,000. That's a $50,000 difference between the income that the lender is using and what household income you feel today. Here's the thing, what you feel your income is hasn't changed, but what the lender actually looks at does. And this moves your qualification lower than what most people expect. Now let's look at another example, and we're going to look at it from 2 different lenses. Okay, so in year 1, this example, you made $160,000. Year 2, you made another $160,000. And then in year 3, it jumped up to $260,000. This happens way more often than you think. A promotion, a big commission year, a career jump, and your household's lifestyle adjusts quickly. And again, these jumps, they feel permanent, but from a mortgage lender standpoint, if this is commissioned income, in your third year, they're still going to use an average income of $160,000. Now, this is completely different if you're salaried. If you were to be salaried at $160,000 a year of household income, and then in year 3, you get a promotion, but that is guaranteed that you're salaried and the income has increased by $100,000. You can use that right away. And this mismatch feels a little unfair for those who have variable income. And this is where people can get very frustrated. It's important to understand that when you're guaranteed that salary, the lender expects that that will continue because there's no chance of you getting a decrease in your salary from one year to the next. context. Let me show you where this can really drag. I had a client who worked in tech. They made over $300,000 a year. And now most of this income came in stock options and annual bonuses. On paper, the income, it looked enormous, but something important that the client didn't factor in. Bonuses were paid in February the year following. So underwriting saw this very differently than the outcome and how the clients were actually feeling from a lifestyle standpoint. The household income felt like $300,000, but underwriting could only use a much smaller portion of that. In this case, the base salary was only $100,000. So we had to use $100,000 of income for year one, wait until we had a second year at $300,000 and take an average of the two. So 2 years into the job, instead of having a $300,000 income, we could only use $200,000 of it. And so interpretation of your income, it varies. Some lenders are conservative, some are flexible. Some will use your current year-to-date income, some won't. Some will wait until the very last month before they'll use that income. All of these factors play a role in how much income or how much mortgage you actually qualify. Some lenders will let you add back income. Some lenders are comfortable with variable income, where some want a longer history. Some are willing to project income in certain professions and others are not. So two identical borrowers can go into two different lenders and get a completely different result. And this is why lender policy on how they look at your income is so important to understand. That's the part that most borrowers don't understand. You might assume that income size determines flexibility, but that's not the case. It's actually policy alignment that determines that, because lenders aren't measuring your best year. They're measuring your most predictable pattern. And when you think of it from the lender side, and I know it's hard to do so, but you got to understand, if you're lending out money and mortgages can last decades, you want to make sure that that pattern is going to continue year after year after year. This is even more important if you're self-employed. This income friction gets 10 times worse because lenders for self-employed people, they usually use their net income. And that means after all expenses are taken. And they do not use your business cash flow. Again, most lenders are this way. And so this distinction, it surprises a lot of super successful business owners, because lowering your income reduces the taxes that you pay, but it can also reduce your borrowing capacity. If you want to follow along and you're self-employed, this is section 2.3 of the workbook. I want you to write down what you reported for your net income over the last 2 years, because that number is often very different than the answer that they give when a broker or bank asks them, hey, how much money do you make? So let me show you how this breaks down. I worked with a business owner who had a super successful company. The revenue and cash flow were strong and their business bank accounts looked healthy. Their accountant did an amazing job of lowering their taxable income. And this meant that their reported income was really small. And I just want to confirm there's nothing illegal about doing this. It is super common. But when they tried to refinance to get the best rate, their lender didn't look at their revenue. They didn't look at their deposits. They looked at their taxable income. And the number was lower than the business owners expected. That business was thriving, but the lender couldn't use that story for qualification. That lender could only use the numbers that they were presented. And that is income friction showing up in real life. And so this is often a conversation that I have with my self-employed individual. There's a break-even point between lowering your taxable income and getting you qualified for a mortgage. And the costs depend on how much more expensive it is to pay for that flexibility for being self-employed versus how much extra money you're going to pay in taxes. It's something that I work with the accountant. And if you know your numbers, you can work with your accountant to make sure that you qualify for the mortgage that you're looking for while still minimizing the amount of money you pay in taxes. Because there's nothing worse than wanting to buy a home or needing to refinance and realizing that it's going to cost you a whole lot more than what you saved in income tax. Now, there's another layer that most homeowners never hear about. This is called a policy bucket. And this is where mortgage buckets enter the picture. Even inside one lender, there may be several different policies depending on the type of mortgage bucket that your mortgage falls into. So just to add, two individuals, same income, same type of income, same home, can actually qualify for two different things depending on which mortgage bucket they actually fall into. There are three main buckets: insured, uninsurable, and insurable. You fall into the insured bucket as soon as you put less than 20% down. And when people see insurance, they assume that it protects them. but it doesn't. It actually protects the bank. So if you were to default, if you were to not pay your mortgage, the lender is protected and they won't lose any money. But because the lender is protected, they often offer you lower interest rates. So in this case, why would everybody not just put a lower down payment? Well, there is a cost of doing this. You can pay up to 4% of the mortgage amount in terms of mortgage insurance, either through CMHC, Genworth, or Canada Guarantee. And that is a large expense just to get a slightly lower interest rate. The next bucket is uninsured mortgages. And in this case, this is a mortgage that the lender cannot insure. They can't cover themselves against loss. Now, this increases the lender risk, which can increase the rate, but it also does something else, and that's discretion. And discretion can cut both ways. It can create flexibility because, again, if you have an insured mortgage, not only does the lender need to improve it, but the person or the company that's providing the insurance also has to prove it as well. With some lenders, that means that uninsured mortgages could increase your flexibility. But in others, because risk is higher, it actually decreases the flexibility that that lender offers. Again, the most common mistake in the industry is saying that with 20% down, lenders are going to give you more flexibility and more freedom. That is not always the case. Now, there is a benefit, and the more equity you have, there are more lender options available to you. Some lenders won't deal with insured mortgages at all, and that increases your option. And the third bucket is often forgotten. It's called insurable. And here's how it looks. So let's say you're buying a home. You're putting 20% down on a home that's worth less than $1 million. You're living in it and you want to pay the whole mortgage off in 25 years. In this situation, the mortgage technically qualifies for insurance. But because you put at least 20% down, you are not required to pay for this insurance. So behind the scenes, the lender can actually buy this insurance on your behalf. And this lowers the overall cost to the lender to give this loan. And that often leads to better pricing for you. And here's the thing, not every lender actually offers these insurable options. A lot of the big five banks just look at the first two buckets, the insured and the uninsurable. And that's why you can go into two different lenders and one person can get a significantly better interest rate than the other. Again, it's important to know which type of mortgages qualify for this. But if you don't know or you think that you fit into this bucket, you may be able to get better interest rates than what you're offered just through a regular bank. This was very, very in-depth, but let me talk to you about this as if you were going through airport security. So your income, think of it like your passport, and your ratios are your boarding pass. But the policy bucket determines which line for security that you actually stand in. Some lines move faster, others slower. Some are more strict, others are flexible. Same traveler, but just different experience. Policy buckets, they quietly shape the structural boundaries around your approval. And like we've said throughout this whole thing, most borrowers, they don't realize it because they only see one thing, income. But approval is layered. So let's stack these layers clearly. Your qualification determines possibility. Your income friction determines the flexibility. The policy bucket defines your boundary, and your margin determines your comfort. And at this point, you can start to see the system. Mortgage approvals are going to stop feeling random. You're going to start to feel mechanical, and mechanical systems can be understood. And here's the important insight. For most households, it's only one of these four layers are actually the stumbling block for you, the real constraint. So again, if you're following along, go to section 2.6. Does your income create structural freedom or structural constraint? Look at your income type. Look at your documentation history. Look at the possible policy buckets you fit. Then I want you to write down which of these four layers you feel like your constraint is. But here's where something interesting happens. Even when people understand all of this, they still end up in a mortgage that feels wrong. Not because the approval was wrong or that the lender made a mistake, but because of something that you can't measure. And that's behavior. You can qualify cleanly, you can leave yourself margin, and you can choose a mortgage that looks intellectual on paper, but you can still feel financial tension inside. And when this happens, it doesn't feel behavioral. It can feel like my mortgage was wrong. It can feel like my rate choice was wrong. It can feel like the structure failed. But mortgages aren't just financial contracts. They're behavioral decisions as well. And if the structure of your mortgage doesn't match your behavior, the strategy eventually breaks. And that's where we're going to go next. Part 2 is all about how lenders see you. Income, debt ratios, math. But after years in the mortgage industry, something couldn't be more clear to me. That behavior drives far more mortgage regret than math ever could. In this video, I'm going to go through the 3 steps to my mortgage alignment model. But it's more important to understand what I had just said. Some of the most financially successful clients that I work with make some of the biggest mortgage mistakes. And this isn't because their income collapsed or that the bank changed programs or even that interest rates skyrocketed. That's not what happened. It's because they overestimated themselves. They didn't take into consideration their behavior. I'm not here from my high horse. I do this at the eye doctors. Okay. I sit down, they put the letters in front of me, and look, I want to get a good score. So by the end, I start to squint. Look, I want to know what those letters are. And I think to myself, this is stupid. This isn't in my best interest. I don't walk around life in this perfect squinting scenario. I walk around with eyes wide open, and people do this for their mortgages all of the time. I'll definitely make extra payments. I'm going to set that up in 6 months. Oh, you know what? I'm going to save all of that extra payment and make one lump sum at the end. I'm going to watch rates closely. Look, that HELOC, I'm not going to touch it. I'm going to invest the difference. I'll stay disciplined. All of these things are things that I hear all of the time. And look, this might be true, but your mortgage doesn't interact with your intentions. It interacts with how you show up day in and day out. And look, when you understand this, you will stop feeling the guilt of spending money. You'll understand what direction you should go with your mortgage. And you'll stop looking back 5 years down the road and realize that you didn't accomplish your goals. When you start to look at your behavior, it starts to become predictable. And predictability allows us to design something for you. So now I want to introduce you to the mortgage alignment model. And there's 3 parts to this. Layer 1 is your money wiring. How do you react when money hits your account? Layer 2 is how access drives your behavior. And this is when you have money available, what does it change in your behavior? And the 3rd layer is stress fit. How much stress can you tolerate? And if you're working through the workbook, I want you to flip to section 3. I want you to answer honestly. Don't do what I do at the eye doctor. Okay? Don't give me the financially impressive answer. The goal of this is not optimization. It's alignment. But let's get into layer 1, your money wiring. This is how do you naturally behave with money. This layer is all about your financial autopilot. Okay. I'm not talking about what do you wish happened or with discipline, what do you want to occur? And this a lot of times is where we see problems with people who qualify with the ratios and the income and the math with the lender, but they run into problems. Ratios don't measure impulse control. They don't measure your optimization bias. They don't measure your lifestyle creep. And they certainly don't measure your execution drift. And we'll get into all 4 of those right now. The first is your impulse control. And so for impulse control, I want you to think about it like this, okay? Your impulse control is what happens when money becomes available. Some people will have $20,000 in their savings account and won't think about it. Others will have spent it before it even hits their account. And I want to be clear. This is not a good versus bad. Okay? There's no judgment in either of these 2 options. This is just about default behavior. And the thing that I want you to think about it is this: the more guardrails that you need to have in place. And to say things differently, mortgage flexibility amplifies this trait. Okay. So a line of credit to one person can be an emergency fund. To someone else, it becomes lifestyle financing. Some examples to think about: what would you do if you got a bonus check or if you got a tax return back? If $10,000 were to show up into your account, what would happen first? Relief? Savings? Would you put it down on your mortgage? Would you invest it or would you spend it? None of these are wrong. It's just important to know so that you can set yourself up for success. Because flexibility is only an advantage if you don't end up using it against yourself. The second point is optimization bias. This is the idea that people assume that future expenses will be cleaner than previous expenses were. Look, I have seen this so many times with budgeting conversations. Someone will come up to me and say, look, that's a one-off. And look, I'll ask for 12 months of their bank statements just to get an idea of what their spending looks like over the year. And it ends up these one-off monthly expenses ended up showing up every single month. Everything is somehow a one-off. Car breaks, one-off. Kids' activity registration, one-off. Vacation, one-off. And look, this is what I want you to know. Life is messy. That's okay. We just need to plan. So the question that I want to ask you is this: are you budgeting for real life or are you budgeting for fantasy? Does your budget include at least some randomness? And here's the honest truth. If there is a recurring surprise, it is no longer a surprise. The third thing that lenders don't measure is lifestyle creep. I see this all the time when people are talking about getting a raise or a promotion, right? They always talk about the benefits of the increased salary. And yes, that is very important. But people often underestimate lifestyle creep. And lifestyle creep is just spending more money when you, and look, it doesn't happen all at once. It happens through small upgrades. You go to slightly nicer restaurants, you take better vacations, you get a nicer vehicle, more convenient spending, more subscriptions, and eventually you realize that you've eaten into a large chunk of that increased salary. Here's the thing: people think because I earn more, I can afford more mortgage. And that is only true if lifestyle creep doesn't take up the additional money as well. So, an honest question to yourself: what does my expenses look like if my income increases? And you can fight against lifestyle creep. Okay. You just need to be very sure what you're willing to move up and what you're going to keep exactly the same. And the last of the four that income doesn't measure is execution drift. And this is where the mortgage that you choose requires you to have future discipline. The time that you're most disciplined is when you're sitting in the office signing the mortgage documents. Nobody plans to drift. Okay. I want that to be clear. Some examples of these plans are like, I'll make lump sums. Look, I'll increase my payments 6 months down the road. Hey, I'm not going to spend as much. I'm going to put my bonus on the mortgage. All of these things have to have discipline after you've signed your documents. And here's the deal: for a lot of people, setting these up while you're in the office in a way that doesn't require you to have discipline later on is often the easiest. In a lot of these flexible mortgage options, that's not possible. After you've signed, these things happen. Look, your kids, the vacation, you meet some new friends, you want to do something, your car breaks down. All of these things make you change plans. And I want to be clear here: a lot of the times it's not all at once. It's, hey, I'm going to miss this payment for this, or hey, I'm going to take a little bit of money out of my line of credit to buy that vehicle or the ATV that I really want. And then over time, the drift in what your goal is changes, but the flexibility or options that you have available don't. And I want to be clear on this: a mortgage that requires future follow through is only as good as the people following through. So, the easiest way to determine if somebody is going to follow through in the future is to see their behavior in the past. And again, if this is you and you have not in the past been able to follow through, this is not an indication of you being a bad person. It just means that guardrails are important to you. And that is okay. There's nothing wrong with that. It's just important for you to understand who you are as a person so that you can choose the best mortgage for you. Now, if this is feeling very personal, let me tell you some other stories, and I hope that you can see yourself in one of these examples. There was a couple that I was working with, and they knew that they wanted to move in the next couple of years. And as is usual in these circumstances, a lot of people who come to me for the first time are just looking for rate. So they asked me, what is the best rate? And I said, okay, yes, that's important, but you told me that you were moving in a couple of years. I asked them, what would bother you the most in 2 years? Would it be that you overpaid for a penalty, that you had to redo some paperwork, or that you didn't have the flexibility to move if you needed to? And they said, you know what? We're looking for a very specific property in a specific location in the new area that we're moving in a couple of years. If something came up in a year from now, we would want to be able to jump on it. And look, they earned a good deal of money and they weren't uncomfortable with having two mortgage payments at the same time. So in this example, again, rate, not the most important thing. The penalty, also not as important. The biggest thing they wanted it was flexibility. So we ended up setting them up with a home equity line of credit on top of their mortgage that would allow for them to access down payment if they needed to. A year and a half later, they found the house that they wanted, were able to put in an offer, and ended up buying it at that time. At the end of the day, we didn't want rate optimization. We wanted flexibility. So they traded off that slightly higher interest rate for the option to get what they actually wanted. This is proper alignment. Here's another example. This person phoned me, and every time I tried to ask another question, they said, I don't care. I want the best rate. Okay, well, let me ask you for more. I don't care. I will go. And so I said, look, you know what? I know that you want the best rate. Answer my questions, and then I'll give you the best rate. And after a few minutes of conversation, here's what I realized. This person often flips their home. They move from one home to the next, continuing to think that they keep getting better and better deals. They actually come to me because their previous broker ended up making them pay such a huge penalty with the mortgage that they had. And this is where it became clear to me. This was just a huge mismatch. Okay. And they continue to push for the best interest rate, missed the mark. This person needed flexibility. They needed a variable interest rate so that they could move from one property to the next. It was also important for them to be able to move this mortgage from one lender to the next. If I had just listened to him and given him the best and lowest 5-year fixed rate, it would have been the most expensive option for him. And so that leads me into the discipline illusion. Okay. This is where people say, I am disciplined. Here is my history. You can see that I am disciplined. But here is an uncomfortable question, one layer deeper in the onion. Are you actually disciplined, or is the environment around you actually making you disciplined? And so when I say this, it's because discipline is often contextual. It really isn't permanent in every situation. It requires context. And so this is often true with people who feel disciplined, where money is automatically transferred out of their account as soon as it enters. It's automatically invested, going to savings accounts, going to vacation accounts. Their checking account stays low. And moving money around takes a lot of effort, and that allows for them to be very disciplined. And so here's the thing, because of that, people say that they're disciplined, but then they'll go from this disciplined situation into an all-in-one mortgage, something with a mortgage, a line of credit, and a bank account all in one. And those guardrails that they set up for themselves, they disappear. And so, not to say that this is good or bad, but in certain circumstances, it isn't you being disciplined. It's the guardrails that you've already set up. So I actually want to tell you a story about this exact situation. Okay, so a client looked at doing the all-in-one mortgage. Mathematically, it made sense. They had a lot of income in comparison to their debts. They were disciplined, and they wanted to pay their mortgage off as fast as they could. When they ended up putting all of their accounts into their mortgage, something changed inside their head psychologically. Instead of saying, hey, this is how much money available, the psychology changed to, man, we're always in debt. Every purchase they made, it felt like they were going backwards. So even though they were saving a ton of money, they stopped going on trips. They ended up not going out. Their lifestyle completely changed. And at the end of their term, they came back to me and said, look, we need to make a change. The trade-off that we're doing for this debt payoff just is not worth it. Again, this is behavioral, not math. And the lesson is not all-in-one mortgages are bad. I just want to be clear. The same mortgage product can be great and terrible depending on the person's interpretation of how their money looks. Because a mortgage doesn't just change the numbers, it changes your environment. And your environment can change your behavior. So in this section, if I can leave you with this, a mortgage can be mathematically amazing and psychologically miserable. If you're not factoring in behavior into your mortgage decision, you can end up making a bad decision, even if mathematically it's the right one. So now I want you to look at your default money pattern. When your payday hits, what do you actually do with it? Do you immediately allocate every dollar? Do you pay the essentials and let the rest float? Or do you spend first and you rationalize it later? And be honest, because nobody is watching. This is just for you. What this reveals is not intelligence. It's not income. It's not intention. And it's not your worth. This reveals your money wiring. This is how you naturally behave when money hits your account. And the more prone you are to spend the money available, the more guardrails that you need in place. On top of that, the more guardrails that you already have requires one level deeper of analysis of, is it the guardrails that are making you disciplined, or is it you? Your mortgage reacts with your habits, not your aspirations. So now we're going to go into layer 2. Because if your default behavior gets exposed when money hits your account, it gets amplified when you add flexibility to your mortgage. Layer 2 is all about access behavior. The question is, what does available money do to change your behavior? And I'm not talking about some money sitting in a savings account or your paycheck entering your account. I'm talking about large sums of money. It's not amount money that you have to use, it's money that you could use. Okay. And this is an important distinction. It is very different than the first layer. I'm talking about money from a line of credit, from proceeds of a refinance, or some of the money from the sale of your home. I worked with a couple who was selling their house and buying another one. They planned on doing a kitchen renovation and wanted to keep some of the money from the proceeds of their sale so that they didn't have to access this at a later date. What ended up happening is a year later, I got a phone call asking if they could refinance to pay for some renovations. Obviously, going through my notes, I said, hey, look, we actually set some money aside for this exact situation. And they had told me, well, you know what? Some things came up. I bought a new car, went on a couple of vacations, and that money is gone. And this was over $100,000 that they had sitting in their bank account that had just disappeared. And look, this isn't a reflection of their morality or good versus bad people. This is just an idea of what your behavior looks like when the situation happened. Okay. They had this money set aside and then they realized, look, we can actually use a portion of that for some of the fun. We don't have to work as hard. I don't have to do as much overtime. And over time, it ended up being spent. Okay. Now they needed to borrow even more money in order to complete the kitchen renovation that they had set aside. This is not a mismatch with math. It made sense for them to keep this aside. They were planning on doing the renovation fairly soon. However, it was a behavioral mismatch, and that's what ended up happening here. Another thing that we see is that some people will add a line of credit as this safety net in case of emergencies. Okay. And for a lot of people, that's exactly what it gets used for. So I don't want to scare you. I don't want to think that that's a huge problem. But here's the thing. Some people, when they have access to it, it looks like this. Okay. So I had a client, year 1, everything was fine. They didn't touch the line of credit. Year 2, same thing. Nothing changed. Year 3, their car had broken down. And look, they wanted to go a little bit bigger than what the car dealership would qualify for them. So they ended up putting it on their line of credit. And then after they used this for their car loan, it opened up the floodgates for all of their other spending. And by the time they had finished their 5-year term, that line of credit ended up having over $200,000. Some would say a reasonable decision to get a more reliable, more expensive vehicle than what they qualify for. The problem with this is there then becomes a fork in the road. This can be a drift into making your available credit into your lifestyle or for it to stay as a one-off. That requires intentional discipline, and it can be very difficult. And in a lot of cases, this works perfectly fine. It stays as a one-off. But again, it's a question that you need to answer for yourself. And again, these flexible products, 95% of the time, they are great. Okay. And people don't misuse them. They don't end up breaking them all at once. They just slightly drift into a different direction and continue on until it becomes a problem for them. To combat against this, I like to recommend that people add friction. Okay. And so the friction principle is simple. If all it takes is a tap, okay, quick transfer, that's when impulse can win. If you have to delay, if it takes you calling your mortgage broker, if you end up having to drive somewhere in order to access your money, that impulse slowly starts to melt away. Make it more difficult for you to access the available funds if this is something that you struggle with. And going back to the first layer, this is why these separate savings accounts work. This is why this out of sight, out of mind investments automatically going to investment accounts end up making people so much money. You're not alone. This is because friction, it creates pause. And pause creates better decisions. If we think about it like this, convenience compresses the quality of your decisions. It makes it worse. And the biggest thing that you don't want to happen is this convenience ends up going from a small detail into a huge category shift. And this is especially true because the danger is not just the spending. And look, there is a group of people who will say, you know what, the equity in my home's increased. I want to have fun for a year or two. I'm going to spend what I have available and I'll deal with the consequences at renewal. And for those people, I just want to give you one word of caution. The danger is not just spending. The danger is reclassification. A strategic tool becomes an everyday tool, and what you get used to is what you start to demand. All of a sudden, when you've spent $10,000 on a vacation, a $1,000 vacation just doesn't hit like it used to. When you've leased a supercar, buying a minivan may not feel as good as it once did. So I just want you to be cautious about doing this. Okay. Yes, you have to live your life. At the same time, it may rob some joy from the future. And when you have this lifestyle creep and this reclassification, it becomes really difficult to reclassify back down to this lower level. So I want you to answer this one question. If equity became easy to access, could you be trusted with it? Would it stay as a strategic goal? Or would it become lifestyle support? And so once we've realized the behavior behind our decisions, the next thing we need to focus on is our ability to handle stress. Because this final question is not, can this work? It's, can you actually live with the stress that this mortgage creates? Core question in layer 3, which is your stress fit, is what kind of mortgage can you actually tolerate? So not only can it mathematically align and behaviorally it can align, but if you can't handle the stress behind it, then it still may not be an option. I like to give this analogy of your two selves. Okay. You have the signing self. That's the one that ends up in front of me as we're going through your mortgage documents. Then there's another self, which is your living self. And that's the person who appears every other time in your life. The person that's signing that mortgage is not the person that's living in it. Because when you're signing, you're usually calm, you're calculated, and you're reasonable. But living you, that looks differently. And look, you can be tired, busy, distracted, under pressure, or just like dealing with everyday life. And I think a perfect example is if any of you have kids, the parent that you are the night before is way different than the parent you are during the day. Look, I want to be more patient. This is how I'm going to react in this certain situation. But sometimes when the chips are down and you're in the heat of the moment, you don't react in the way that you want to when you are talking about it at night. The same thing can be true for your mortgage. Okay. And I just want you to make sure that you have clear understanding. Now, something else that I want you to focus on is there can actually be different stresses with a choice that you make. Okay. So let's think about fixed rate versus variable rate. In a fixed rate, you have exit stress. Okay. So if you were to break the mortgage, the penalty is going to be much higher than if you took the variable. So the stress when you're leaving is going to be much worse than if you took the variable. However, the variable interest rate gives you uncertainty stress. Okay, this is during your term. You're not sure if rates are going to go up or down. What's going to happen to your payments? Some people are way better at living with one than the other, or they're willing to exchange. Hey, I might pay a higher penalty, but I'm going to sleep much better at night. It's just important to understand what stress you're avoiding and what stress you're getting with your choice. Another stress to think about is your flexibility stress. Okay, so if you have access to money, are you going to stay disciplined? Okay. That is a stress for some. Other people, they don't worry about it, but it's important to know in your circumstance how you would react. And the last, especially for those investors, is the leverage stress. Hey, if I borrow all this extra money, can I handle the stress of that? Am I going to run into a certain situation. So from a math standpoint, the return in the S&P 500, if you were to be able to get it tax-free, it always makes sense to borrow all of the money from your house and put it into the stock market. Mathematically, over a long enough time horizon, it makes sense to do that. Again, assuming that it's tax-free. However, hardly anyone does it. And why? Well, the stress is immense. And investing in general, people often sell at the worst and buy at the worst. Okay. And why is that? Because they cannot handle the stress of the situation. And no, this is not me advocating for you borrowing all of the money and putting it in the stock market. It's just to highlight the point that math is not the only thing that you should be focused on. So let me show you another example of how this works, where the math works, but for the human, it doesn't. Okay. So there was a situation, I'm sure everyone was aware, where interest rates were extremely low. The Bank of Canada had just announced that rates were going to stay low for a long time. And although we could get a 1.5% interest rate on a 5-year fixed, this person chose a 1% variable. Okay. And so understanding that they're exchanging risk, taking a variable versus fixed, they decided that this was their best option. Okay. And look, this person was a physician. They made lots of money. There was no issue as rates started to rise. What ended up happening is they just got fatigue hearing again and again about the potential of interest rates rising, that they ended up locking into a 5-year fix at 6.49%. So not only did they not take advantage of the 1% interest rate, but they ended up locking in at the peak of the market. They ended up making the mistake on both sides of the coin, the worst case scenario on both ends. Now, let me tell you an example where the math actually worked in their favor. So I had another client. This was probably 12 years ago now, who ended up getting a variable interest rate because historically speaking, variable rate had outperformed fixed rates and they were expecting rates to drop. Here's the thing, they were right. Rates continued to drop over the next 12 months, but they could not handle the fact that they were constantly checking their mortgage. Mathematically, it worked. They ended up saving way more money than if they had gone with a fixed rate. But for their lifestyle, for what they wanted, it just wasn't worth it. So they ended up locking into a fixed rate at that time. And the variable rate continued to go down, but they slept well knowing that they didn't have to worry about their mortgage for the next 5 years. And so this is where I want to get into details. Look, I'm all for these advanced mortgage strategies that a lot of online content creators talk about. But again, what they're missing is this behavioral mindset behind it. Okay, so let me give you an example. There was a tech startup. I had this client who ended up being the CEO of a startup, really well researched guy, understood some of the advanced strategies that were being taught online, reading lots of books about it, working with their accountant. They were trying to do everything right. And they had great income. Their startup was doing amazing. They had started to make ground hiring employees, but everyone was screaming at him from all different directions. Hey, get your investment in real estate. Hey, buy some Bitcoin, invest in the stock market. All of these things were pulling him in all of these different directions. He came to me and said, Jeff, I feel like I'm running around trying to save all of these nickels. If I just focused on my startup, I would make significantly more money than worrying about everything else. And so I tell this story to highlight this. You have to have access capacity for some of these advanced strategies that are put out. Yes, they work. And yes, they can be amazing and save you tons of money. But if they come at the expense of something else, you just need to be okay with the trade-off. Your mortgage, it doesn't test you on your best month. It tests you when your life gets expensive or when something changes or when your discipline lapses. That's when you're tested. In this case, you can think to yourself, so if my flexibility increased, would it have strategic opportunity for me? Is there a benefit? Could it cause lifestyle? Would this feel empowering or exhausting? If something changed, would you obsess about it or would you be able to let it go? And I hope this helps take you from what's the best mortgage rate? What mortgage should I choose? To the better question, to what version of me does this mortgage require? Me on my best day or me on my day to day? And at this point, you've done the diagnosis. You know how you naturally handle money. You know what increased access would do for you. And you know what kind of mortgage stress you can actually tolerate. But insight alone doesn't solve this problem because self awareness without action is nothing. And understanding yourself doesn't automatically show you what mortgage to choose. That's the next step. If you're following along in the workbook, this is where you need to answer. Do I need guardrails? Do I need flexibility? Do I need leverage? Do I need control, consistency, or optionality? Because different personalities need different mortgage designs. The wrong way to choose a mortgage is what's the best rate? The better question is what mortgage aligns with the way that I actually behave? Because the goal was not just awareness. The goal was for you to be able to act on this and to translate it to your everyday life. Part 4 is the transition from behavioral design into actual mortgage design. Not just rate shopping, but actual design. And that's what we'll get into next. Part 3 was all about diagnosis. It was about how you dealt with money and what having access to extra money would do to your decision making process and what stress you're willing to live. But just like at a doctor's office, you're not going to leave once you hear what's wrong with you. You'd wait to hear the treatment. That's what part 4 is all about. We're talking about how do we take what we've learned and translate it into actionable and reasonable mortgage decisions. What most people do is they'll choose the option that they like the best. And I want to push back on that for you. Don't do that. What you want to choose is figure out what problem you're solving and choose the one that aligns with that problem. Okay, so let's talk about 4 different priorities. We talk about stability. We talk about mobility. We talk about leverage and we talk about discipline. Each one of those is great for one person and can be terrible for the next. Okay, so it's important to understand who likes it and who's going to go towards that and who should actually go towards it. Okay, so for instance, for stability, people who value stability want to know what their mortgage payments are going to be. They're the people who, if they buy an appliance, are going to purchase the extended warranty. Their thought process is, I would rather know what my payments are, even if they're a little bit higher, than think about this uncertainty and have it on my mind on a regular basis. Those are the people who are predisposed to choose it, but who should actually choose the stable window. Well, the biggest thing is if interest rate of 0.5 to 1% is going to cause you to have to sell your home, you need to prioritize stability. If there's a possibility that your income will not increase over the next 5 to 10 years. So I think about people who are recently retired. Any increase in mortgage payments can have huge impacts on their overall budget. Those people should really focus on stability. At the same time, on the behavioral level, is somebody who would be constantly checking the Bank of Canada rate announcements before you bought a house, or 6 months or a year before your renewal. And that's all that you're thinking about. Those people are the ones that should focus and prioritize stability. So for the people who are actually supposed to prioritize stability, what should we be choosing? Well, there's the super obvious ones. Okay, we talk about 5 and 10-year fixed rates. And often that's where the conversation stops. For the people who are super against unknown and super against having any unpredictability, taking a 5 or a 10-year fixed rate is the only option. But I want to have some nuance to this conversation. There's also something called a variable rate mortgage. Okay. And so when we think of variable rates, that's where we think that the payment changes over time. But the actual name for that is called an adjustable rate. A variable rate keeps the payment the same, but the amount that goes to principal and interest changes depending on what happens with your rate. So this can be a great compromise, especially for those people who are looking to sell in the near term, but want to make sure that their payment stays the same. And the other option is a 3-year fixed rate. And look, if variable isn't for you or the concern of interest rates rising could negatively impact you, taking a 3 or 4-year fixed rate would also fall under this stability bucket. But when you prioritize stability, there's definitely some trade-offs. So people who value stability probably aren't going to get a line of credit. And look, having the priority of stability comes with the trade-off of adaptability and flexibility. Often a lot of these advanced mortgage techniques, they can't be used with a stable priority. It also means if there's major changes to rates over the short term in the next year or two, you might miss out on that. And again, You just need to be okay with that trade off in comparison to the benefits. As long as you're aware that having stability as your main focus, it's designed to protect your peace, but at the expense of your flexibility. The second priority is mobility. This is often just thought about the ability to sell your house and move somewhere else. But that's not only the case. And it's amazing how many people talk to me about porting as an option, because that is where most people focus on online education to talk about mortgage porting. And it is an important factor, but it's so much deeper than just that. So, for those of you who don't know, mortgage porting is the ability to move your mortgage from one house to the next if you were to buy and sell. And each lender has a bunch of different options as to what they allow. If your mortgage is increasing or decreasing or staying the same, do they charge you a penalty? Do they figure out what the penalty would be and add it to your mortgage rate? All of those things are factored in. But that's not the only thing that prioritizing mobility is about. The other thing is to keep your options open inside your house. For instance, if you're not sure what to do, taking an open term, meaning a term without a penalty to allow for you an extra month or two while you're making that decision, is another example of mobility. The other thing is, if you want to be able to make a change in the next year or two with interest rates, if you're expecting them to go down, well, that is prioritizing mobility. So what human problem are you actually trying to solve? You're trying to avoid the feeling of feeling trapped. Someone who prefers having mobility would rather have less certainty in their life for the ability to make changes if they needed to. And yes, people who should focus on this are people who are looking to move or may require a promotion. Also, people who are focused on a relationship transition, possibly looking to get married, get engaged, have a kid. All of those things can change what your life will become. And the other side of this is also just making sure that you have some flexibility. There might be a refinance in the future, renovations. Preserving the ability to make a choice at a later date is possible. You're not stuck in your mortgage decision if your renewal comes in at the wrong time. You just need to make sure that you're prioritizing the ability to move and not be locked into something that is too stable for your situation. So people in this situation will often say, hey, I don't know what my life is going to happen. I'm undecided. You know what? Life changes fast. This type of conversation leads towards wanting to focus your priority on mobility. So what mortgage options are there for someone who should prioritize mobility? Well, yes, variable rates are one of the most often cited as something for mobility. There's the option, because it's only going to have 3 months of interest as a penalty. Choosing that can be a great option. Getting a line of credit's another option. In some cases, having a fully open line of credit gives you the flexibility to make a decision 3 to 6 months from now. People will do this when they think, hey, rates might come down in that time. I'm willing to pay a little bit more to be able to lock into a rate at a later date. The other, and maybe the most extreme example, is an open term. In some cases, hey, I need to wait 2 weeks before I actually make this decision whether I'm going to get this job or not. And taking an open term, even if it's at 8, 9, or 10%, may be in your best interest so that you know all of the information and can make an informed decision. Yep, it's going to cost you more in the short term. However, having all of the data points to make an informed decision might save you tens of thousands of dollars. And so having mobility as your priority, it fixes the feeling of being trapped. It reduces penalties. It allows for you to make decisions and go from what you've decided to something else without a large consequence. At the same time, you're trading off certainty and predictability. There's more work that you have to do on your end in order to make sure that this is actually a smart decision. You need to follow the news or follow up with the decision that's being made. And then once you made a decision, that then becomes another decision-making process. So it can be more work or more cognitive load. And it's just important to understand that trade-off that you're making. And so this design protects your ability to be maneuverable at the expense of predictability. And the third priority is leverage. And in this case, the borrower needs capital. The fear is that they have inaccessible capital. And to these type of people who like having leverage, okay, they feel like having access to money is a safety blanket. Now, what does this look like? Who should want to prioritize leverage? It's business owners who need to have their cash flow needs met on a day-to-day basis. It's people who are looking to purchase a rental property or to do a renovation but aren't sure of the timing. It's also to have some fallback, have some access to money if you're a commissioned employee who may have a bad month. All of these people should prioritize leverage. Okay. People who love it will say, I need access to it. And one of those two things are very different. Okay. So leverage can be a double-edged sword. Having access to it can be amazing for those who need it. And like we talked about in the behavioral section, those people who have access to it but can't manage it, it can become their biggest enemy. The best fit is somebody who can actually use their equity strategic. So this would be investors, entrepreneurs, business owners. All of these people, leverage can be in their best interest. These are things like home equity lines of credit, the all-in-one mortgages, refinancing. All of these things can come into play. And the trade-offs are important. This is behavioral drift, right? Leveling up your lifestyle without leveling up your income. These are problems that prioritizing leverage can have. So obviously we've talked about lines of credit, combo mortgages, all-in-one mortgages, essentially anything that you can add a line of credit to. That's what people think of with leverage. But there's other things that you can do that would create leverage and don't necessarily have to do with the mortgage product themselves. For instance, extending an amortization to as long as possible, or in some cases, paying interest only, can increase your leverage. Okay, so it means you can deploy that capital elsewhere. But again, deploying capital is only beneficial when the returns outweigh the expense that you have. And the fourth priority is guardrails and discipline. Okay, so somebody who prioritizes guardrails is going to look for a mortgage where they set it and they forget it and they never want to look at it again. Okay, someone who wants this or who prefers this is someone who never wants to think about their mortgage. In all fairness, they probably haven't gotten this far into this video. Okay, essentially, all they want is what's the rate and to send it in. Okay, that is the person who wants this simplicity. Who should take this simplicity? Somebody who, if they have access to money, would spend it, should not be leveraging. They should be prioritizing guardrails. Make sure that the mortgage that they choose has the ability to make regular payments. The other thing is someone who has regular payments. Another person who should prioritize this is somebody who has a goal to retire after their mortgage is paid off and their timeline is tight. You don't want to mess around with the potential of, am I going to be a great fit for an all-in-one mortgage? Focus on what your payments need to be, set it, and that is the only option that's available to you. This is a pay your mortgage first type of situation. This is not focusing on all of the advanced metrics. It's getting down, paying your mortgage and paying it off as fast as you can. When we look at this, these are your traditional mortgage options. Even better if the lender that you use is not the one that you bank with, the one that you can't even see what the payments are looking. You can't decrease the payments. You can't make changes. All you know is that's the amount of money that leaves your account on a regular basis. It is as simple as set it and forget it. And you're going to wait 5 years until your broker or your bank calls you and you're going to renew again. Again, people who want this option should not always take it. But the people who this is a top priority for, those are the people that should take it. And if that is you, it is completely fine. I think people so focus on all of these bells and whistles, they forget that there's a real purpose for just a traditional mortgage as well. So we've hinted at it a little bit here about some of these mismatches of what you want versus what you need. And I'm going to tell you a couple of quick different stories to kind of get you in the mindset and to make sure that you're seeing this as clearly as possible. One of the examples I had was a new account. They ran the numbers. They knew that the variable interest rate was the better option. Here's the deal. The rate for the variable at about 1%, and we were at about a 1.5% fixed rate on the fixed side. Now, here's the issue. If rates had gone up to 2%, that this person wouldn't be able to afford their house over the next 3 years. They needed to finish a 3-year stint in a lower level job before they could get paid considerably more after that. So they were trying to prioritize mobility, to prioritize this variable rate option. Instead, what they actually needed was stability. They needed to make sure that they could survive for the next 3 years and then make a decision from there. And look, they didn't need to choose a 5-year fixed rate. That was their concern. They could have chosen a 3-year fixed rate and went from there. That's what they ended up choosing. It ended up not working out. The variable interest rate was considerably higher at the time that they renewed. However, the benefit for them was they could make a decision, and that was their choice. Another example of mismatched priorities was a client that I had that was coming up for renewal. Okay. They knew that they wanted to move. They had just had their second kid and they were in a 2-bedroom house. They wanted another child, and they knew by the time the 5-year term was up that they would have moved. At the same time, one of their dads had said, 5-year fixed rate, that's the only option, and that's what you should choose. They were trying to focus on stability when they really needed flexibility. And the last example I want to give you is the stockbroker. Okay. And we see the same thing a lot with real estate agents. So this stockbroker ended up loving leverage. They wanted to take money out of their house to invest in the stock market. They understood that the return in the stock market was way better than what their mortgage rate charged. So it was a no-brainer. But here's the problem. When the stock market dropped, their employment also slowed down. First, it started by not getting their bonuses, and then eventually they were laid off. So not only were they highly leveraged, they ended up having to sell their stock portfolio to pay off a portion of their mortgage at a huge loss, because not only did their income stop, but they were also highly leveraged in their job and their investments. Realtors do this with investment properties. When investment properties are doing bad, their job is also doing bad. So in some cases, having leverage can be a huge problem when you're leveraged something that is for your employment as well as for your investment at the same time. Diversification is key. And in a lot of these cases, having a house that's paid off free and clear is an amazing thing, especially when you have a highly volatile job. And so let's zoom out. Look, none of these borrowers that I talked about were stupid. None of them chose bad products. Honestly, if you were to talk to people, most people who said, hey, I want leverage, and they took a leverage mortgage, that makes sense. However, okay, let's zoom out. In each of these stories, nobody was stupid. In fact, most of the people who made the decision that sounded smart at the time. And that's what I want to clear up. That's what's dangerous. The analytical borrower, they stuck to math. The certainty seeker just wanted peace. And the investor optimized for opportunity. They optimized around their strengths. But what they needed to do was something else entirely. They needed to prioritize their vulnerabilities. And really, that's the mistake. That's what I want you to focus on. All of this information led to this. The right mortgage is not built for what is working well today. It's built around what happens when life gets messy. And so do you remember part 3 when we talked about this? We said signing you is calm. You're analytical. You're optimistic. You're intentional. But living you is tired, is busy, is reactive. This is the person that the mortgage actually has to survive. So this is the actual decision rule. Do not design your mortgage for the ideal you. Design it for the real you. Remember, the right mortgage is not designed for you in your best month. It's designed around your worst one. So if uncertainty breaks you, prioritize stability. If being trapped breaks you, then prioritize mobility. If a missed opportunity breaks you, then prioritize leverage. And if behavior drift will break you, then prioritize for discipline. So again, it's not what's the best mortgage. It's not even what's the smartest mortgage. It's what mortgage is least likely to hurt me. And once you know that, mortgage design becomes extremely clear. And up until now, we've been solving human problems. So part 3, we've talked about behavior. Part 4, we've talked about mortgage design. Good intentions don't get approved. The lender doesn't care that the strategy makes sense. They care whether you fit the rule book. And sometimes the mortgage that makes sense for your life doesn't survive the system. And that's part 5. Up until now, we built the mortgage decision pyramid from the ground up. We started with your life, then your lender, then we looked at your behavior, then we looked at mortgage design and mortgage decisions. But now we go to the 5th and final layer, execution. Because look, all 4 of these other sections are about choosing the right mortgage. But if you choose the right mortgage, but you can't qualify for it, then it doesn't matter. There's nothing worse than coming up with a great strategy and then there's a document issue, there's a property issue, a timing issue that makes you not able to get the mortgage that you planned for. And suddenly the mortgage that made perfect sense is no longer available to you. And it's important to note that mortgage approvals are not just one yes or no decision. It's a framework. It's a system. And systems fail at their weakest point, which brings us to the execution framework. It's the 3-legged stool of mortgage approvals. I want you to think of mortgage approvals like a 3-legged stool, each one supporting the mortgage approval. If one of them breaks, the whole mortgage approval falls apart. And this is where people get blindsided because most borrowers, most people don't actually understand that there's 3 separate legs. They only think of one, and that's income. Do I make enough money to qualify? But again, lenders are not approving you just on one number. They're approving you on the entire system. And remember, that system has 3 legs. The first is you, and it's not just your income. It's your credit, your repayment history. It's your debt. It's where your down payment came from. And the most important thing, do your documents actually tell a coherent story to the lender? Because this surprises people all of the time. You can make amazing money and still fail on this leg. Now, what about leg 2? This one is the property. Again, lenders aren't just approving you. They're also approving the property that you're purchasing as well. And this is where people get caught off guard. Lenders don't care if your property is ugly. And you might, but the lender doesn't. What they don't want is a risky property. And so what is a risky property? Well, does it have structural issues? Does it have an active insurance claim? Is it on leased land? Is it a property in a super small town? If it's a condo, is there any money in the reserve funds? All of these things are super important. We'll go into more detail of each one, but this second leg is often overlooked. You can be the perfect borrower, but have the property be dead on arrival. And then there's a leg that almost nobody thinks about, and that is timing. Because people think that approval is permanent, but it's not. Approvals expire, rates change. Builders, they delay possession of a home. Lenders, they recheck employment. Lender exceptions can disappear, especially over a long enough time. And suddenly this deal that worked 3, 4, 5 months ago doesn't work today. Not because anyone had made a mistake before, but because time has passed and things have changed. And that's the framework. 3 legs. You, the property, and time. Now let's break each one. Look, there's some super common landmines that people fall into that I just want you to avoid. And the first one is job changes. And this one could be huge. You can work in the same industry, even make more money, and it can change how you're approved. And this is especially true if you get a new job and you're on probation, or if you go from a salary to a commission role. If in qualification we're using bonuses, or it becomes from a salaried position to being self-employed or a consultant. Even role changes can play a huge factor in your qualification. So if I can leave you with this in this section is, don't assume that higher income always means better. It's important to check before you make that decision to make sure it doesn't affect your qualification. The next classic mistake is debt. And look, everyone thinks of the car loan or maxing out your credit cards, but there are other factors in place as well. Think about putting your furniture on payments. Look, you just bought a new house, you're buying a larger home, or you live with your parents. You need some furniture, some appliances, but putting them on get now, pay later plan actually increases the debt payments that you have and can affect your ability to qualify. It's super important if you are going to use these services to wait until after the mortgage closes. Don't do anything beforehand that could jeopardize your qualification. And look, so many people obsess over the credit score, and lenders care just as much about your repayment as they do about the number that comes out in your credit score. Another factor is weird deposits. So anything that has a deposit over $5,000 will trigger the lender to ask questions about where it came from. The lender needs to know, is it borrowed? Is it gifted? Is it an undisclosed debt? Is it a money laundering issue? All of these things are factors that the lender needs to be able to have something explained. All of these cause you to have to explain to the lender what's going on. And look, I want to really focus on gifted down payments here. Gifted down payments, they're super popular, especially now when first-time homebuyers are having a really hard time getting into the market. And that is usually not a problem, but timing really matters. Lenders often ask for a gift letter as well as proof of deposit, but especially if you're very close to your closing and you're providing these documents late, they may ask for the person who's giving you the money to also send proof of their money in their account. Another common thing is if that money is coming from another country, if you don't have the money in your account at least 90 days before closing, they're going to ask for history of the accounts and what country that money is coming from. In certain countries, lenders will not allow money to be transferred from that country to be used as a down payment. So this is super important for you to understand. Another common pitfall that people fall into is consumer proposals or bankruptcies. And this can happen both ways. The first way is saying that, hey, I've finished my consumer proposal or I just declared bankruptcy. My ratios are good. I should be able to purchase a house. That is not always an option. On the other end, what people think is, hey, because I declared bankruptcy or consumer proposal, that automatically disqualifies me from traditional financing. That's not the case either. So what is the truth? If you've declared bankruptcy, most lenders require at least 7 years after the bankruptcy before you can purchase a home with traditional financing. There are a ton of lenders when you put 20% down who are able to get around this requirement. On the other side, a consumer proposal is slightly different. Once you've paid off the proposal, and this is important, as long as you've done so for at least 2 years, most lenders will be able to lend to you again. There are some lenders who only require 1 year wait before they'll lend to you again. But here's the thing. This is the part that most people don't understand. After a consumer proposal or a bankruptcy, one key point needs to happen. You need at least 2 different credit sources, credit cards, lines of credit, something along those lines with a limit of at least $2,000. That shows that you can be responsible again with money. On the same note, if house is involved in a consumer proposal or bankruptcy, that can also complicate things. But I want you to hear one thing. It doesn't automatically disqualify you from approval. Disclose it up front because you don't want someone figuring this out just as you're about to close and there's no other options available to you. But at the same time, don't take it like a death knell that you cannot purchase a home if you've had a mistake in the past, either consumer proposal or bankruptcy. There's lots of options available to you. Another pitfall that's massively overlooked is child support and spousal support. And a lot of people think that lenders will take this and just subtract it from their income, but that is hardly ever the case. And yes, there are lenders who do that, but for the most part, when you go to a bank, they're going to treat that as if it's a debt payment. On the other side, if you receive child support or spousal support or the child tax benefit, that income can be used to help qualification. Again, there's limits to how much we can use, but all 3 of those are great options for a lot of people. If you owe spousal or child support, it's important to disclose that and let people know because that can be something that comes up at a later date. And if it happens, it can destroy a deal that we've worked so hard for. And look, if you owe child or spousal support, it's so important that you disclose it. The worst case scenario that happens is the lender finds out right before closing and they end up canceling a deal. Not only do we not get the house and not get the mortgage, but it can open you up to legal problems as well. And for this leg, I want to leave you with this. Your approval is based on the version of you that got approved. If you change anything about yourself, then your approval can change as well. And it's important to know that before any changes are made. But even if you are perfect, The property also has to be, and that is like two. Look, people think that mortgages are all about them, but it isn't. The lender is approving two different things, you and the property. And this is something that I want you to take away. Ugly does not mean that it can't be financed, that you can't get a mortgage on it. But some property problems absolutely do matter. So let's make this super simple with a traffic light system. So, what is a green light? These are ugly issues. So, a dated kitchen, okay, carpet in the bathroom, all the things that people don't like, but the lender doesn't really care about. If you have old paint or cosmetic wear, if the bathrooms are outdated or the landscaping is poor, these are not commonly issues that the lender sees. Lenders don't really care if your property is ugly. They care if it's functional and they care if it's marketable. So then what would be a yellow traffic light? What is something that we need to proceed with caution? What do we need to slow down with? One of the biggest one is if the home is on leased land. And the reason being is these homes can be very difficult to try to sell. Leased land is essentially that you own the home, but you don't own the land underneath. You're paying a monthly rent, if you want to call it, for that property. The downside is registering a mortgage on leased land can be difficult, especially when there's multiple homes on one piece of land. Again, this isn't necessarily a no, but a lot of lenders won't look at this type of property. So it just needs some added scrutiny before you put an offer in. Another thing that can cause issues is private water or sewer. So in certain cases, some lenders require a water report. In some cases, lenders require a well report or a septic inspection before they'll lend to you. Others don't. It's just important to know what your lender requirement is and to make sure that it passes before you waive any conditions for your purchase of your home. And I know what some of you might be saying. This is all just rural properties. These are properties out in the boonies. I live in the city. The property concern doesn't apply to me. Well, that's not always the case. The big thing that we see property issues arise is with condos. And specifically with condos, we see reserve fund, which is how much money is in the pot after you've collected your condo fees and paid out your expenses. When the reserve funds or when the amount of cash in this account end up being low, it can raise one of two problems. In some cases, it means you're going to have a huge increase in your condo fees. Okay, that's problem number one. This can affect your ability to pay your mortgage, and lenders take this super seriously. On the other side, it can cause what's called a special assessment, which is essentially that the condo board is going to ask you for money. And whether you can come up with it or not, they will continue to ask for that money. And you have to either pay them or sell your home. And so if there's a large amount of people who are unable to pay the special assessment, it can affect the value of your. So these condo reserve funds are something that lenders look at a lot. So if you're purchasing a condo, having this reviewed by a lawyer is super important. Another common issue with properties are unique properties. Okay. In some cases, if you have a really large property or expensive property, lenders may reduce how much they lend. On the other hand, they might not lend to you at all if the property is too large or is too expensive. If a property is too remote, doesn't have heating, okay, can only be lived in for 3 seasons, or is on an island or needs boat access, this can also cause problems. Again, not a red light, not something that you have to avoid at all costs. You just need to take extra steps and precautions. Another interesting point is hard to value homes. Okay. If you have a property that's in a townhouse complex, but you have a detached home and there's no other detached homes in the area, that can be a problem. Another issue can be if you have a home that's close to residential buildings or a train station. Those can cause problems with financing as well. And out of all of this, if you were to take one thing away, you've got to think about it from the lender's perspective. The harder that it would be to sell your home, the more the lender is going to look into this and have more scrutiny. That means the harder it is to sell your home, the more cautious the lender will be. Okay, now we get into the red traffic light. And this either means to stop or it means that you need to fix the problem right away. Okay. And so I want to introduce a concept. It's called a purchase plus improvement loan. Okay. So when you're buying a home and you need to do renovations, there are lenders out there who will lend you money to do this renovation. And essentially, what they require of you is you need to pay for the renovations up front. And then once it's completed, then and only then will they give you the money back. And so for some of these instances, you can use this purchase plus improvement loan to fix the problem. But there is important factors in place. So let's give the first example. Let's say that there's mold. Okay. You're going to purchase a house, there's black mold, people can't live in it. In most cases, the lender is just going to say no to this. But there are lenders who will be okay as long as you are going to fix that problem. But here's the thing, once you open up the walls, there can be extra problems that you haven't seen. And then it's a requirement that those are also fixed. So that is a risk to you when you're purchasing a home with these problems. On top of that, because you're opening up the walls after you've purchased it, there's no opportunity to get additional funds. So that would come out of your own pocket, your own expenses. So again, just a word of caution for these type of properties. Another common issue that we see is knob and tube wiring. Okay. A lot of lenders and a lot of insurers have problems with this type of wiring. It could be dangerous, flammable, etc. And a lot of people will just decline a deal unless you fix it or it's removed before you purchase. Another common one is structural cracks. So either if you have a foundation and there's visible cracks or if there's water on the floor, these are things that some lenders will have issues with. And the vast majority, unless they're fixed, just won't finance. Another huge red flag for lenders is half-finished renovation. So in some cases, people have bought homes and halfway through their renovations, they run out of money and want to sell the home. Here's a problem. A lot of lenders won't allow for the home to be sold until it's completed. Because at the end of the day, if there's plumbing problems or electrical problems, they don't know that that exists until they can actually turn on the water or turn on the light. And if it's halfway through the renovation, that may not be an option. A lot of lenders in this situation pass, or it needs to be fixed before you were able to get traditional finance. And another one that just happened recently to one of my clients is an active insurance claim. So we had a client who was looking to purchase a home, and in between the time they purchased and they closed, there was a crack in the foundation that ended up leaking into the basement. So when an appraiser came out to look at this property, they saw that the bottom of all of the baseboards were cut and that the crack was exposed and was trying to be fixed. Now, here's the deal. Even though the insurance claim was ongoing, the client could not close on this home until after the insurance work was done. And to this point, the client had assumed because the property was livable, it was just in their basement, that it would be financeable. But that is not always the case. Okay, so now we've talked about you and the property. But even if both of those things work, the next leg to the stool is timing. This is the leg that most borrowers miss. Time. Because approvals, they're not frozen in amber, they expire. And before we get into this timing, there's something that drives me absolutely crazy that I just want to address now. Pre-approvals. So people will come to me and tell me that they've been pre-approved with their bank or their broker. Then when I ask them to send me their documentation so that I can do a double check, they say, oh, I didn't supply any documents. If you're going through a pre-approval and you have not submitted any documents, you are not pre-approved. It's not worth the paper that it's written on. Okay, there's important insights. We talked about this in section 2. The way that documentation works and how the lender will look at your income is a super important step. Sure, you can have a rate held, but changes to income or property taxes can all make that rate hold not worth anything. At the same time, I've seen it again and again where people will come to me after they put in an offer thinking that they were pre-approved, only to find out that they couldn't qualify based off of the documentation that they provided. Again, this is why we always ask for all documentation up front. A rate hold does not automatically mean that your underwriter is approving the deal. And look, this is also true though, that just because you have the documents up front doesn't mean the lender can't recheck your income or qualification closer to the time that you purchase. So some people will buy a home and then quit their job halfway in between, hoping that the lender doesn't check. But the lender is well within their right to do so. So it's important to note that just because you've had sign off on income doesn't mean that the lender can't recheck at a later date. And look, this is especially true if you're buying a new build. In some cases, some of the condo buildings can take 3, 4, maybe even 5 years to complete. Some lenders will hold a rate for that full amount of time. What we've seen in COVID is a lot of these lenders who advertised that ended up rechecking income and requalifying the rate anyways. Now, again, I'm not here to paint this all with a bad brush. There were lenders who did honor the rates that were held for people, but it's just important to know that the longer that time moves on, the more likely is that a lender is going to recheck your income, your debts, and your qualification. And so some people will come to me and say, look, my new build, it's ready to be completed in 90 days. So I want to get a pre-approval and then I know that I'm good. Here's the problem. A lot of these builds end up having delays. Not only that, but in a lot of cases, people will have a contradiction between when the house is able to be purchased and when it is that you can move into it or occupy it. Those are two different dates. And a lot of people will move into a property and rent it from the builder before you actually get your financing. Okay. And so at the end of the day, the time that a rate hold exists, the time that we can hold a rate for is based off of the time that the mortgage itself closes. So what do I say? Well, here's the deal. The very first thing is a rate hold is good for anywhere from 90 to 130 days, depending on the lender. Okay. Yes, in certain new build situations with specific lenders, it could be longer than that, but that traditionally is what happens. In terms of a pre-approval, there are three things as long as they don't change, then you are going to be able to continue to be pre-approved. One is your income. The second is your credit. And the third is lender rates and lender guidelines. Okay. So those factors are what is important for your pre-approval. If you're looking for a specific exception that is no longer available, that's something that can greatly affect your ability to get approved. At the same time, if you were to switch jobs or end up purchasing a new vehicle and putting it on payments, all of those things can be rechecked with time. And this is something that I just want to be crystal clear about. There's some files that only work based off of one lender accepting it, one insurer accepting it, and the need for one or two or maybe even three exceptions. Okay, this is a really fragile leg to stand on. And what I like to tell people who are in this situation is your deal, it only works in this one example. And so the property and the person need to have a strong leg in order to support this weaker leg. In this case, it's always important to have a condition of financing when there's only one option available for you. And so look, some deals, they don't fail because anything was wrong with the person or the property. It's a timing issue. And especially when you're purchasing a new build that can take 4 or 5 years to complete, so much in your life can change. And if it does, your approval can change as well. Now, look, as a reward for watching so far into the video, I want to give you how to negotiate the best interest rate in Canada. And look, if after all that we've done, your one takeaway is, I want the lowest rate only, then I failed. However, once your life fit is right, once your lender fit is right, once your behavioral fit is right, and once your mortgage design is correct, when you can compare apples to apples, it is so important to know how to negotiate your interest rate. And here's a common misconception. Most people actually negotiate their interest rate backwards. They go to their bank or they go to their broker and they take it to the other and try to get that person to match it or beat it by a little bit. And look, this feels smart. You're getting a slightly better deal, but it really isn't because you're only forcing your banker, your broker to match or beat it by a little bit. How do you actually get the best deal? The first thing you do is you go to both parties. So If you have a mortgage, you're going to go to your current lender and then you're going to go to a broker. If you don't have a home, go to Reddit and find out what bank is offering the best rates in the market today. Then go to your bank and broker and compare and say, look, I want the best interest rate up front. And both of them are going to tell you the same thing. They're going to say, hey, if you get a better interest rate, come back to me and we'll match it or beat it. Tell them, I'm not going to do that. I want you to give me the best interest rate up front. No matching games, no back and forth. Whoever gets the best rate is the one that I'm going to take. And the reason for doing this is simple. Knowing that they've only got one shot, they have to give you the floor rate that they have, the lowest rate, the lowest option. I've seen it happen where someone has done this with me as the broker and the bank has offered them 0.5% better than what I could do. And so once you have the same product, okay, the same options, you want to make sure that you're picking the lowest rate that you can. Again, just to be clear, things you want to make sure you compare. You want to make sure that the penalties are the same. So the big five banks can charge higher penalties than some other lenders. Make sure you're comparing apples to apples. Is there restrictions when it comes to refinancing? Can you move the mortgage without selling the home? Does this lender offer a line of credit if it's important to you? All of these things are important to consider before you even start the negotiations. Another important insight is two different things. On the broker end, you want to make sure that you work with a broker who does a considerable amount of business. Some might say 50 million, some might say $100 million worth of mortgage volume. That means that they will not only get the best interest rates, but lenders offer something called discretion. Essentially, it's lower interest rates for clients or for brokers who do a lot of business with that. And this is where you can get considerably better interest rates than what your neighbor might get from a different broker. On the lender side, you want to make sure that they are ending up speaking with management or elsewhere for the rate. Okay. If they're able to offer something up front, it probably means that there's a better option available. Again, this is almost always the case when you walk into your branch, you tell them that you're working with a mortgage broker and you want the best rate up front. They will tell you that they've got to take it away, get the best rate, and then come back to you. It's super common, and it is the way to get the best mortgage rates in Canada. At this point, the mortgage decision pyramid is complete. Let's zoom out for a second. We started with your life because mortgage decisions, they don't start with rate. They start with what's going on in your life. Then we went with lender fit because even if a mortgage makes sense for your life, it's important that the lender is also on board. Then we talked about behavior. And now you know that your mortgage doesn't interact with your best intentions, but how you show up on a day-to-day basis. And then we talked about mortgage design because once you understand this, you can actually choose what mortgage is best for you. And lastly, we just finished execution. And look, that's the full pyramid. And honestly, this is enough to make dramatically better mortgage decisions. You now understand the mortgage like most people never will. But if you want to understand how borrowers let their mortgage work for them, not just avoid the mistakes, but how to take advantage of your mortgage, that is what part 6 is all about. It's where we move on from choosing the right mortgage and into using mortgage debt strategically. We're going to talk about leverage, capital access, optimization, tax efficient investments, and rentals. So if your goal is simply don't screw this up, you can probably stop here. You've got what you need. But if your goal is how do I use my mortgage intelligently over time, keep going. Up until now, we've talked about how to build a durable mortgage. And that alone puts you ahead of most Canadian homeowners. But eventually, some borrowers change from saying, what's the safest mortgage option to how do I get my mortgage debt to work for me? And that's what this section on advanced techniques is all about. I'm going to answer this question as if you're sitting across from me, walking you through the exact framework that I talk to clients about when they call me asking for this specific advice. And I want you to think about this like a bus ride. Okay. There's 4 separate stops we're going to talk about, and you're free to get off at the one that makes the most sense for you. Stop 1 is paying off your mortgage as quickly as you can. Stop 2 is invest in the difference. The third stop is making your mortgage tax deductible. And the fourth one is rentals. And look, this is something that I've noticed talking about these advanced strategies over the last 12 years. For one, they require bandwidth, they require attention. The second part is they require you to understand your behavior. Let's talk about the most simple and basic one to start: paying off your mortgage as quickly as possible. Let's get off at stop one. The first thing that I want to explain to you is something that is often confused. Okay, we're going to talk about accelerated payments. When people think of accelerated payments, they think of biweekly or weekly payments, but they don't truly understand what the term accelerated even means. They know that you pay your mortgage off faster than if you were to choose the monthly option. But why? What does it mean? Well, essentially, all you're doing when you accelerate your mortgage payments is you pay 13 months worth of payments in a 12-month time frame. This is most often marketed as for biweekly and weekly payments only, but that is not the case. You can pay an extra month's payment with monthly or even semi-monthly payment options. So then why are you paying your mortgage off faster? Well, the extra money that you put down just goes directly to principal. What that means is you save the interest on the last payment as soon as you make that first payment. So for the whole lifetime of your mortgage, from when you make that payment onwards, the interest on that amount gets saved. So it can make a huge difference in paying off your mortgage quickly, even one extra month's payment every year. And remember, when you hear the word accelerated, it just means making 13 payments in 12 months. Now, the most basic way to do this is through a traditional mortgage. Okay, so the 2.0 version of this is to put even more money down. So not just pay one extra month's payment, but actually pay any additional money you have left over at the end of the month onto your mortgage. Again, paying additional money just means it goes directly to principal and pays off your mortgage faster. Now, here's the problem with these traditional mortgages. If you were to make these payments, that money is no longer available to you. At the same time, the interest savings that you have are real. Okay. And the amount that you can save by doing this consistently is huge. It can take 5, maybe even 10 years off of your mortgage payments by doing this on a regular basis. So now, what's the next level? Well, if you were to do this, most people are going to have to set aside a rainy day fund. They might also have to set money aside for renovation or a trip. They don't want to put all of this money onto their mortgage. So the next level of this is to add a line of credit where you can take all of your money from all of these savings accounts and put it on your mortgage. The benefit is, even if you need to use this money later, the interest that you save as you've put this money down is real and continues on. The other benefit is your payments then have more to go to principal and less to interest during that time frame. This is especially beneficial for people who are self-employed. If you have to pay HST or you have to pay income tax on a regular basis, keeping the money in your mortgage to save the interest until you have to pay it can save you hundreds, sometimes even thousands of dollars a year. So if the 3.0 version is to get rid of your savings account, the 4.0 version of this is to also get rid of your checking account. This is called the all-in-one mortgage, where essentially all of your money goes into your mortgage to pay off the principal all at the same time. The benefit of this is, even if you're using the money throughout the month, for the days that the money is sitting in your mortgage, you're not paying interest on. Again, this can help save some additional money. At the same time, there's some drawbacks to this as well. Having all of your money sitting in an account, like we talked about in part 4, can make you change your behavior, can make you go on less trips. It can make you more stressed. All of these things are important factors. And honestly, the largest driver of paying down your mortgage with these Manulife One or these all-in-one mortgage products mainly has to do with the difference from your income versus your expenses and making those extra payments over time. So if we just talked about stop 1, everybody would agree that this makes complete sense. To pay your mortgage off faster is just a no-brainer. But the difference is not paying off your mortgage versus not. there's another option that you have available instead of just paying off your debt. Now, the benefit of paying off your debt is that it's simple. On top of that, the stress relief that you have when you're mortgage free is huge. Also, if you were to lose your job, knowing that you have the money set aside that you could survive for months rather than weeks is a really important factor for a lot of people when they pick this stop, when they choose to pay off their mortgage as quickly as possible. But there is another option, and that option is investing the difference instead. Okay, and in this case, the 1.0 version is just getting a regular mortgage. And instead of putting the extra money towards your mortgage, you put it into an investment account. And why would you do this? Well, historically speaking, the stock market outproduces the interest rate that you're paying. So on average, the stock market gives you a 9 to 10% return. And with mortgage rates being between 4 and 5%, this can make sense when you look at the math in the long run. Now, there is a problem with this. The stock market doesn't function like a 9 or 10% year over year return. It fluctuates wildly. You can see a 50% drop in price. You can see a 30% increase in price. So understanding that this is not a day to day or a year to year return like your interest rate is going to be is super important. The other and most important factor with this is the tax implications. So yes, if you make a 9 or 10% return, that's amazing. However, if you have to pay tax on that, the actual rate of return that you receive is less. Now, what most people do in this situation is they take advantage of their tax-free savings account. And that, again, is step number 1.0. So essentially, all you're doing, instead of making the extra monthly payment that you would make with an accelerated payment, you take that amount of money and you put it into your tax-free savings account. The same thing can be done with the 2.0 version, which again, if you have additional money, you would invest it instead. So when you look at historical averages, stop number 2 makes way more sense than stop number 1. But when should you not do this? Well, the first thing is when your time horizon is fairly short. And so what do I mean by time horizon? Well, if you're looking to retire in the next 3 to 5 years, there's a chance that the market can go down substantially in that short of a time frame. When we look at longer term, 20, 30, 40 years, that's when this historical average can really take hold. If we're looking at a shorter time frame, the risk of potentially losing money is much higher than if you're looking at this in a larger scale. The other thing to take notice of is a lot of people make the mistake of pulling money out at the worst possible time. Seeing the stock market crash 20, 30, 40% can make people sell their investments. And when they do that, they can lose out on the rebound if and when it happens. So to invest at the peak and then take money out at the worst possible scenario is actually a super common investment strategy, even though it's the worst possible thing to do. If you're going to make this decision, you have to commit, because if you change your mind when the worst happens, it'll be the worst of both scenarios. So again, putting extra money into your investments is the 1.0 or 2.0 version. The 3.0 version is, instead of making principal and interest payments, to just use interest only payments. So in this case, a lot of people will use a line of credit. And the reason for doing that is the extra money that you would pay to your principal, you can now use to invest instead. Now, in 2008 in the US, this was actually a common strategy of just having to pay the interest on your mortgage. When housing prices went down, unfortunately, there was a large amount of people who weren't able to make their payments. Now, in Canada, the amount of money that you can have only in a line of credit maxes out at 65% of the house's value. Not to say that it's impossible. We're already in a scenario where some parts of Canada have seen this 30 to 35% drop in home prices, but it's not going to have as extreme of an impact as the US, which allowed for a much larger loan to value to be an interest only payments. Again, this is an extra risk. And to be honest with you, with the extra amount of interest that you have to pay, the difference between the two often isn't worth it. Have I seen it done? Yes. Do I usually recommend it? No. And that is our second bus stop. So now let's talk about stop number 3, and that is making your mortgage tax deductible. There are 3 ways that you can make your mortgage tax deductible. The first way is borrowing to invest. And in some cases, this is called the Smith maneuver commonly. But borrowing to invest is as simple as this. You're going to take money that you would normally invest and you're going to pay off your mortgage with it. Then you're going to re-borrow that money from the line of credit, and the money that you re-borrow can then be written off. Now, there's an important caveat or there's an important thing that needs to be done. The biggest thing is the investment that you make has to reasonably earn money. You can't borrow from your line of credit to do a renovation to your home and think that it's going to become tax deductible. That's not what this is. You need to invest in the stock market or rental properties. That's what makes this a tax deduction. The other important thing to factor in is it can't be used in a registered account. So you can't use this towards your tax-free savings or your RSP. So the downside of this is, yes, you're going to get your mortgage to be tax deductible, but the unregistered account that you've invested in is also going to be charged some. So yes, while your mortgage is going to be tax deductible, the money that you earn in the unregistered account is also going to be taxed. So why is this beneficial? Well, it's beneficial if you've already maxed out your TFSA or your RRSP. Okay, so this can be a great option for somebody who's looking to invest anyways. And so how does it work? Well, it can sound super complicated, but essentially all you have to do is move your money into the mortgage and then back out through the line of credit. Once it's gone through the mortgage, the borrowing ends up being considered from your property. So again, your investment money goes into your mortgage. Then the mortgage payment pays down because you have a line of credit that readvances, so increases as you pay down the principal. Some amount of that becomes available to you. You re-borrow that money, you invest it, and then the money that you borrow becomes tax deductible. So if that's the 1.0 version, the 2.0 version is if you already have unregistered accounts. If you already have unregistered investment accounts, you can actually sell those investments, apply them to your mortgage, and then re-borrow them off of the line of credit and make it fully tax deductible. So this can be a great option for someone who already has a lot of money in unregistered funds. So I told you that there was a 3.0 version, and I'm actually going to say that this one is also alongside the 4th stop. So halfway in between, we're going to talk about rental properties. And before we go into the tax implications of rental properties, I'm going to talk about 2 very important things when it comes to should you purchase a rental property and what strategy should you have when you do so. So when we talk about rental properties, there's one number that you need to know, and that's cash flow. And when you think about cash flow, I want you to think about this. This is how much income you make, subtract all of your expenses. No, I'm not talking just your mortgage and your property taxes. And no, don't just include your utilities as well. I'm talking about your maintenance. I'm talking about the potential that you don't have a tenant. So that's called a vacancy rate. All of these things need to be factored in. If the rental property you're looking to buy doesn't cash flow, you shouldn't buy it. And this was a super popular strategy when it came to the run up to when housing went crazy in 2021. What ended up happening was people stopped looking at cash flow and they looked at something else called the 1% rule. It was supposed to be a quick hack for how to know if you should buy a property or not. What it did was it made condos look way better than what they were. Essentially, the goal for this 1% rule was to figure out what your rent was and the purchase price and avoid all other expenses. Take the extra 2 minutes, run all of the numbers, and make sure you're buying a rental property with positive cash flow. One other thing I'd like to talk to you about is there is a chance that rents do go down. So again, making sure that you have a proper vacancy rate, which means there's a chance that you won't have the property rented for a certain amount of time, as well as factoring in where rents could drop to and making sure that you still have a positive cash flow. With all that being said, there's 2 different options that are available to you if you're looking to use mortgages to invest in real estate. And this is a super common misconception. So a lot of people think that All lenders will look at your income that you're making from the deal and add it to your income. Most of the time, people think it's half. And on the debt side, they'll take 100% of your debt, add it to your liabilities. And that is how the lender will look at your ratios. And yes, a lot of lenders do look at it this way. And by doing so, makes it extremely difficult for you to qualify for purchasing a rental property. However, there are tons of lenders who don't look at it like this. The difference is between what's called an offset and an add back. The add back is just adding your income and adding your liabilities or your expenses to your income for qualification. An offset is taking a look at how much income you make and your expenses. And if your income is higher than your expenses, adding that amount to your income. And if your expenses are higher, they take the difference, not the full amount, and they add that amount to your liabilities. So this again is why cash flow is so important. So if you do have positive cash flow and the lenders use one of these offset options, there's a good chance that owning a rental property actually will help you qualify, not hurt your qualification. Now, this is important. Almost all lenders, now not all of them, but almost all lenders will make you qualify for the rental property that you're purchasing with this type of add back option. And when you do so what does this mean? Well, any rental property you already own, they'll allow to use this offset option. So what does this mean? Well, if you own a home that you live in and then also are looking to purchase a rental property, assuming with how the lender looks at the offsets of your other properties, the cash flow, and it works out from the lender standpoint, you need to qualify for the rental property you're purchasing plus the home you live in. Now, the 2.0 version of this is especially easy for people who haven't bought a home yet. Okay? There was lots of talk about the BRRRR method, which is where you'd buy a house, you'd renovate it, then you'd refinance it, and then you'd do it again. And honestly, right now, with how expensive it is to renovate and how cheaply you can buy houses with basement units, this strategy probably doesn't make a lot of sense. This does flip-flop depending on how expensive houses are in comparison to how expensive the renovations can be. So it's important to make sure you run your numbers on a fairly regular basis. At the same time, there is a strategy if you don't own a home to move into a property that has a basement unit. The benefit is you can live in one of the units and rent out the other, aggressively saving for a down payment. The benefit of doing so is you only have to put the minimum down payment. So 5% on the first 500,000 and 10% after that. And in a year time, if you want to buy another home, you can do so with 5% down as well. You just need to make sure that you're moving into that property. Are you going to be able to refinance to get the down payment? No. But are you able to save aggressively because you might be living in a basement and having someone upstairs help pay for the mortgage? Possibly. Again, not for everybody, but this is a more advanced technique. Now, at the same time, is there risk with doing so? Absolutely. I'll say two large risks. One thing we talked about, investing in condos and how overall they were very difficult to cash flow. They also had another big problem that single family homes also run into as well. There's only one tenant. So if that tenant stops paying, 100% of the responsibility of the mortgage falls on yourself. This is why I love the duplex, the triplex, even the fourplex if possible. Because if one of the tenants don't pay, you still have a portion of the mortgage being covered. However, things do happen. It's important to make sure that you can cover these expenses if something goes wrong. Either having a slush fund, having money set aside, or income that's high enough to be able to cover these payments. The second thing is leverage. So when you're only putting 5% down, you are using a lot of leverage. And leverage is amazing when housing prices are increasing. Your rate of return can be substantial. Even if housing prices only go up 2%, assuming that you cash flow, the amount of your return could be 20 times that based off of the amount of money that you put in. But here's the problem. Leverage also works against you when housing goes down. When you're only putting 5% down, if housing were to drop 5%, you now have 0% of your down payment. Your house is not worth anything. So there's two important factors. One, with positive cash flow, you can wait out some of these market downturns. At the same time, making sure that you have a better understanding of what could happen and the potential that you could have to hold on to property for 10 years just for the market to come back. Again, think about it that way. If that scares you, then doing this is probably not for you. Is there money to be made investing in real estate? Well, yes, there can be. It has historically been a great way to increase your net worth. Is the guarantee that this is going to work in the future? Absolutely not. The other important thing to talk about when we talk about rentals is it is not passive income like investing in the stock market. And an important thing to think about is if you're going to be investing, especially if you're going to do a lot of it, you can use a property manager to deal with some of the problems. The downside is, even if you have a property manager, they're still going to call you if they need help or need your approval to do something. So it's not completely hands off. And the return, again, can not only matter in regards to the cash flow, but also what's happening in the stock market. So I said that there's an opportunity or a way that you can make your house tax deductible with a rental property. So how do you do this? It's called rental cash damming. And essentially all you do is you're going to take the rent that you receive and you're going to pay down your mortgage with it. This only works when you have these combo mortgage line of credit that has a line of credit that increases as you pay down your mortgage. So when you take that rent, you pay down your mortgage, you can then re-borrow the amount that you have to pay off your expenses. This can include your mortgage, your property taxes, etc. And when you re-borrow that money becomes tax deductible. Now, again, people who are against rental cash damming will say, that it's complicated. And a lot of people say that it's complicated. And I don't necessarily think it is. I think it's important to have a great accountant to make sure that they're aware and to set it up properly. But once that's done, I feel like things move fairly smoothly. At the same time, what they'll say is, yeah, but you're reborrowing at a line of credit rate. And that can be true, but a lot of the lenders will allow for you to re-lock in the amount. You can do that after every payment, but most of the time people will wait 6 or 12 months to lock in their rate so they're not paying the higher line of credit interest rate. And look, I'm not saying rental cash damming is a perfect option. It's not for everybody, but it is an important thing to think about. And it is an advanced technique. So you should be aware of it. You should be able to look into it. And if it makes sense for your situation, you should not have any fear to set it up. And look, as a quick side note, people will often ask me my opinions on Airbnbs or short-term rentals. And what I'll say to you is this: the more chances you have vacancy, the higher the risk that you have. So either having additional rental properties where you have a large amount of surplus cash flow, which means you're making a lot more money that can cover months of time where your Airbnb or your short-term rental might be vacant. That's a good option. The other option is you just make so much money that you're okay with paying the difference if you don't rent it out. But for most first-time home buyers or for most people starting out, to go into these short-term rentals or Airbnb might not be your best first option. So a bonus fit stop that I want to talk to you about was infinite banking. And although infinite banking sounds like a mortgage option, it really isn't. It's more likely and usually attached to a life insurance policy. So what is infinite banking? It's essentially you taking a whole life policy and paying more than you have to. The additional money that you put towards your life insurance policy gets invested. And so why do we talk about this as infinite banking? Well, the benefit is you can then reborrow that money. And the argument is the dividends that you receive or the investment that you receive within your whole life policy can continue to work. You have to pay the interest on the money you reborrow, but essentially you can use that money twice. So what does this have to do with mortgages? Well, this is similar to the invest the difference, okay? However, there's one added layer. What I found is this infinite banking or be your own bank often is beneficial or the most beneficial for people who are self-employed. Benefit being is that they can buy this life insurance policy inside a corporation and they can pay their dividends with pre-tax dollars. So there can be some benefits to this. However, for the vast majority of people, using this as a mortgage strategy probably doesn't make a lot of sense. Now, if you already have a life insurance policy that you've overinvested in on a regular basis, borrowing that money instead of borrowing money from a line of credit can save you a little bit of money. Is it a game changer? Well, it can be, again, if your dividends or your investments do much better than what you're paying when you reborrow the money. However, this again is leverage. And like we talked about with the rental properties, leverage can go both ways. It becomes one more debt obligation that you have to make. Now, if you were to lose a job, could you cash in this whole life policy and not make those payments? Yes. Is that something that you want to do if the life insurance policy that you bought was there to protect your family? Probably not. So again, it's not necessarily specific to a mortgage product, but a lot of people put the be your own bank or the infinite banking in mortgages. So I thought it would be a disservice not to talk about it. And look, with these advanced techniques, there's two things that I want you to take away. The first is that these systems need bandwidth and precision. Okay. So the first thing, bandwidth, what I'm talking about is you need to take time to learn and to understand what option is best for you. Talking to accountants, financial advisors, mortgage brokers all together can take some time. Other thing is if you have misalignment, look, if you're a person who's not good with money and then you create a bunch of leverage, these advanced techniques can create even more leverage. It can cause huge problems. So I just want you to be aware that misalignment plus these advanced strategies can make things go from bad to worse. So two things you need to know. Just make sure you understand this before making a decision to go ahead with one of these advanced strategies. And look, at this point, we've gone far beyond rate. We've gone far beyond fixed versus variable, far beyond what's the best mortgage. And honestly, this was the point. Thank you for taking the time to go through the worksheets that we've had, because most mortgage decisions, they start way too late in the conversation. And what we've done here is build the full mortgage decision pyramid from the bottom up.